Good morning, good afternoon, and good evening, ladies and gentlemen. It's a pleasure to welcome you to today's Sustainable Finance Conference. My name is Carlos Guiné. I'm the head of sustainability at EIOPA, and it's my pleasure to host you today for half a day of discussions on very relevant and actual topics, and to discuss some of the work that we have also been doing from EIOPA on these important topics, and we, of course, welcome your participation and your feedback throughout the discussion. Today's event is under the motto of Insurance and Innovation for Climate Resilient Europe, and we hope you will participate actively in today's discussions as we go along through our agenda. I wanted to start by informing you that our event is being recorded, and we will post a recording on EIOPA's website later on. And in addition to this, we also have the pleasure to broadcast it live on LinkedIn as we go through today's discussions. So we also, as I mentioned, very much welcome your active participation in the discussions and your contributions. And for this, we hope you will join us in Slido. We will have polls organized throughout the event to make it also interactive and collect your inputs and feedback. And in order to test it, we wanted to start the day with a poll. So you see on screen the QR code or the code that you can use, hashtag EU Sustainable Finance 2026, that you can use on slido.com to participate in our initial poll, which is just to get us a bit warmed up and get a view on our audience today. We have already over 600 participants, and we would love to know a bit more which sector our audience today is coming from. So while you respond on Slido, let me give you a quick overview of our agenda for today. So we will start briefly with an opening address from our chairperson, Petra Hilkema, followed by a keynote speech from Commissioner Hoekstra, which is recorded, and then we will go for a panel discussion on the benefits of the European approach for natural catastrophe risk management, related to some work that we have recently published together with our colleagues from the European Stability Mechanism. Following this, we will have a presentation on a public consultation that we have recently ran at EIOPA, some work that we are doing on the prudential treatment of adaptation measures in Solvency II. And after a short coffee break, we will then have a panel discussion on this interesting topic of bringing together, let's say, the technological, the digital, and the sustainability transitions, how the two topics can support each other as we progress. And we will end our event with a consumer-focused presentation on consumers understanding their coverage for NatCat, what are the issues we face there. And then to wrap up our event, our Executive Director, Damian Jaworski, will join us for some brief concluding remarks. So that's a bit our agenda for today. And throughout our event, not for the initial opening address and keynote speech, but throughout our event, we will also welcome you to participate using the Q&A function of the Teams Town Hall. So you can submit your questions when we will open the floor and participate in the discussion in that way. So now let's quickly look at the results of our Slido poll. So thank you so much. We had over 200 responses, and we see a clear dominance of the private sector participants, as we expected based on the registrations. So very good and very much welcome to all of you. but we see other groups also well represented, public sector regulators and other activities also part of our discussion. So I hope this creates the atmosphere and the diversified group of stakeholders today hopefully will enrich our discussion, and we very much look forward to it. So with this, let me then move on with our program. And I would be very happy to invite and welcome our EIOPA chairperson, Petra Hilkema, to deliver an opening address to all of you to start our event today. So welcome, Petra. It's a pleasure to have you. And the floor is yours.
Yes, thank you, Carlos, and good morning, good afternoon, and good evening to all of you. Thank you for the interest. I see we have a reach already of over 700 participants, which given the time difference is, I think, a real show of interest in this topic. And I will not disappoint you. I think I have a lot to say about that topic. So let me kick off and say, dear distinguished guests and colleagues, it is a pleasure for me to open this year's Sustainable Finance Conference as we come together to address a key challenge that we are facing today: climate change and its profound impact on our financial systems, on our societies, and even on our way of life. Across our continent, storms, floods, heat waves, and droughts are becoming more frequent and more severe. I do not think that that is just a problem on our continent, but given our mandate, I will focus on that today. We witness the impacts of these devastating events, and the fundamental question before us is whether our economies, our financial systems, and our citizens are equipped to withstand them. But let me start with a cautiously optimistic note. Most people in the European Union, and that is about 85%, see climate change as something that needs attention, not only to protect the environment, but also to keep the economy strong and everyday life running as normal, as usual. The public sentiment gives us a strong collective responsibility to act, and EIOPA is committed to deliver its fair share within its mandate of policyholder protection and financial stability. Yet the reality we face remains stark. If you browse through the protection gap dashboard that you can find on our website, you will see that historically, 3/4, 75% of economic losses from natural catastrophes have not been insured in the European Union. Since 1981, wildfires, storms, floods have cost about 900 billion in direct losses within the European Union. On the one side, projections from the MSCI Institute suggest that losses from physical climate hazards in Europe could be almost 4 times higher, 3.78 times, than now by 2050. So only in 25 years, 4 times higher. And on the other side, the Network for Greening the Financial System estimates that by 2050, the same year, if current policies go unchecked, we are looking at worldwide GDP losses of up to 15% due to climate-related incidents. So in short, climate and nature-related risks are risks that potentially have systemic impacts and definitely have economic impact. And I'm not only describing a future problem. This is based on the present. It's material and it's growing. So against this backdrop, the insurance and reinsurance sector plays a pivotal role as the backbone of risk management in society and a key pillar of our economy. It is central to how Europe can prepare for and adapt to the increasing shocks ahead. Now, this brings me to an important benchmark for measuring progress. It is our ability to reduce the insurance protection gap. That's the gap between disaster's costs and what is actually insured and therefore covered for by insurance. The bigger the gap, the more of the damage is left on the shoulders of citizens, businesses, and governments, often ad hoc. EIOPA's analysis points to several causes. So a first cause is the demand side. Many consumers and small businesses really underestimate their risk, as well as the financial consequences for them in those events. Floods are sometimes seen as once-in-a-century event. Heat waves are viewed as uncomfortable rather than life-threatening. In this line of thought, insurance becomes a nice-to-have rather than a must-have. Changes in behavior here are possible, but they require sustained work, better information to citizens and awareness, clearer communication, and meaningful risk-aligned incentives. On the supply side, insurers and reinsurers also face their own storm. Climate and nature-related risks are becoming more frequent, more severe, and as well as less predictable. So historical data is no longer a reliable guide. Modeling becomes more complex, uncertainty grows, and in some regions, insurability dries out. So without the appropriate tools, data, and frameworks, as well as adaptation measures that effectively reduce the risk, insurers may withdraw from high-risk areas or raise their prices up to levels that many cannot afford, yet that do reflect the risk, which further widens the protection gap. Our focus is to close this gap to enhance societal resilience, which demands coordinated actions from everyone in the ecosystem. That means policyholders, consumers, reinsurance, insurance, financial markets, policymakers, and supervisors. Now, you may wonder what we do all about this at EIOPA and also the why. So sustainability is central to our work because sustainability risk is no longer an abstract. These risks are already material financial risks for insurers and occupational pensions with direct consequences for consumers and for financial stability. That is why sustainable insurance and pension sector is a pillar of societal resilience. When insurance markets function well, they absorb the shocks, they speed up the reconstruction, they help keep businesses and communities and supply chains running. But preserving the societal role over the long term requires a forward-looking risk management with better data, better models, and supervision that ensures that risks are properly identified, measured, and managed. And this is why our conference today focuses on 4 key themes. First, how risk pooling can support insurability as risks become more correlated. Second, how sustainability and financial innovation can support resilience and coverage. Third, how adaptation measures can be recognized prudently, including within Solvency II. And fourth, how to strengthen consumer outcomes and awareness. I will say a bit more about all these 4 themes, but before I do that, I want to say this very clearly. Our engagement is not driven by ecological advocacy. It is to deliver independent technical advice grounded in our mandate, consumer protection, sound companies, and financial stability. It is about strong supervision of the material risks that jeopardize the fundamental role of insurance and our way of living as we know it today. So let me dive a bit into the 4 themes of today. First, the risk pooling. Now, let me start here by saying that our objective is not to replace private markets. It is to support their functioning and the extent of their reach. So their capacity to absorb losses can be further strengthened by well-designed risk pooling structures that leverage diversification across countries and perils. Our work with the European Stability Mechanism builds directly on the earlier work of the European Central Bank and EIOPA and aims to quantify key elements of such a framework. How large a pool might be needed and how much should be saved through diversification. The idea that these mechanisms can contribute to the availability and affordability of insurance in the long term is crucial. When designed well, such structures ensure that no single entity carries the full burden of what I would call a financial earthquake. They can make coverage available and affordable where it might otherwise disappear. while still preserving the central role, and it is a central role, of private insurers and market-based mechanisms. The decision to establish such mechanisms will rest with political leaders and key decision makers at the national and EU level. Our role is to assess possible impacts, formulate proposals, and stimulate discussions. Together, these forms of cooperation would strengthen economic resilience, affordability, and availability of insurance protection across Europe, while supporting a more forward-looking understanding of climate risk. On the second topic, innovation and technology, EIOPA's recent work together with the EU Space Agency has shown how high-resolution satellite imagery combined with advanced modeling can transform supervisory risk assessment. New opportunities are emerging to monitor risks, but innovation is not just about better data. It is about enabling smarter supervision where limited resources are directed to the right firms at the right time, before vulnerabilities turn into crises. For insurers, new technologies can also mean more accurate underwriting, better portfolio management, and faster claims handling. And it also gives a hint at where prevention and adaptation measures, flood walls, fire-resistant materials when building, will have the greatest impact. This is an exciting emerging field where further work is required to unlock the benefits that can arise from combining new technologies and data with traditional models and ground evidence. Then on the third topic, creating incentives for risk reduction. For adaptation is not about responding to disasters. It's not about responding. It is about preparing for them by taking measures that can reduce losses when the catastrophe strikes. When insurers support risk-reducing measures, this should be acknowledged. In Solvency II lingo, recognized in the way risks and capital requirements are calibrated. Smart regulation should reflect genuine reductions in risk and encourage forward-looking risk management. This is what a risk-based approach stands for. And EIOPA is examining if and how prudential rules can better capture the impact of adaptation measures without compromising financial safety and soundness, of course. The objective is not to relax standards. It's to align them with the realities of a changing climate and to ensure that the financial system helps build resilience rather than merely counts the losses. And then finally, we need to talk about boosting the uptake in natural catastrophe insurance. And I'm pleased that later today, we will discuss not only what your insurance contract covers, but particularly also what it doesn't, and how we can make sure that consumers actually understand those exclusions and then act. It is easy to understand that when more people and firms are insured, communities recover faster from shocks and economies become less vulnerable to the long-term impacts of climate-related disasters. Yet it is much harder to keep natural catastrophe insurance front of mind for consumers, as well as affordable and accessible everywhere, no matter your postcode. We need to talk about that. So let me conclude. I began by presenting the current situation and the bleak outlook forecast ahead. I then focused on EIOPA's role, doing what we do best, providing sound technical advice and promoting strong risk-based supervision. And my message could not be clearer. The cost of inaction will infinitively be higher than the cost of timely and well-designed intervention. And here every actor has a part to play. Citizens can make informed choices to protect themselves and their community. They can make the effort to understand the risks they're facing and act. Businesses can embed climate resilience and nature-based solutions into their strategies, and also again consider where they are and if they are protected well, or do they need to do more. Insurers and reinsurers, our first line of defense against climate risk, must continue to innovate, refine their models, sell products that offer real value for money while promoting adaptation and mitigation. And national governments must create the enabling frameworks. building resilient infrastructure, building coach, encourage adaptation and mitigation, as well as the uptake of insurance against this risk while aligning incentives and ultimately providing support where it is needed most, but only ex post where needed most. It's at the end. And the EU institutions must ensure coherence and they must promote cooperation. We can really learn here from each other. We can help each other. And for supervisors, including EIOPA, our task is to ensure that sustainability risk, as well as adaptation and mitigation measures, are fully integrated into our frameworks. And on top of that, we must raise awareness about the need for natural catastrophe insurance that stays available and affordable over time. We must not only look at today's dangers, we must also look at those forming at the horizon. And as supervisors, we are well positioned to do so, for we are trained to cut through the noise and focus on the risk. For the underlying risk has not faded. It's intensifying. And yet, we still have a moment, a window of opportunity to shape our response. We can choose to react piecemeal and too late, or to act together, coordinated, preventative, and fair. If we act with clarity, unity, and a shared sense of responsibility, then the European Union can face the coming storms, not as a victim of circumstance, but as a community more prepared, more protected, more resilient. And this is how we ensure that when the water rises, the community, the European Union, will stand more firmly. Thank you very much. Back to you, Carlos.
Thank you very much, Petra, for those very, very rich words. A lot of topics on such a short amount of time, just really highlighting how important and how relevant these topics are for us. As I mentioned in my introduction, we will not open for Q&A, but maybe we can take a moment just to hear a bit more from you, also related to actually one question we got from one participant. So you mentioned in your speech a couple of times, you covered, of course, a lot of ground of many EIOPA activities, but you highlighted, and this is really a message from EIOPA that we keep bringing, that all stakeholders have a role to play. And today we have, of course, an audience around 900 people right now, a very diversified stakeholders. So maybe you could elaborate and share a bit more your thoughts on that perspective, what roles we would see from EIOPA, also beyond, let's say, the insurance sector, and how this entire ecosystem needs to work together to achieve this goal of sustainability and resilience.
Yeah, thanks, Carlos. And I think this is the key topic to get to the action we need. As I said in my opening remarks, I think the urgency is there. We see it all. I do not believe that anyone who's involved is unwilling to do something, but who is going to act first and who is going to incentivize the other acting? And here I do have a concern, because still when I talk to many stakeholders, they often explain to me what the others should be doing, And this is one of the reasons why EIOPA itself continues to draft policy advice, to get data, to share those data back, to make the dashboards, to look at what we can do on capital requirements. We try to also look what we can do. And I need everyone in the ecosystem to do that, and I refer to it. So let me go back to the paper that was published in 2023, December 23, on our website, the first paper of EIOPA and the ECB. And here clearly there is what I call and what we call the ladder approach. If you go from the bottom to the top, you will see that you need, as I said, you need consumers, but also cities to start thinking, what are the risks? Am I in an area with a lot of forest fires? Then how should my garden look? What building materials should I use? What road should be there? If I build in an area that could be flooded, am I aware of that? Can I take measures? And what is the best measure? Defending each house or building a dam? But you need to do the risk assessment and you need to work on that. And that in itself is already a cooperation of many stakeholders involved in that decision, in consumers, risk people, insurers, consultants who understand the risk and who can help you identify those risks, and rules, local government rules. But once you've done the adaptation mitigation and you want insurance, you also need to get an insurance. There need to be products, and those products will have a price. And the price will reflect the risk. We do feel that insurers need to price for the risk. But a lot can help if you have large pools, if you have multiple perils in the pools, if you have a large area in the pool, and if you can reinsure or maybe make use of the wider capital market through NatCat, etc. So parametric insurance. So insurance, reinsurance, capital markets, that's the next step on the ladder. And then finally, there are good examples of public-private partnerships. And in 24, we published a paper with 12 examples of good working national public-private partnerships, and we identify good practices, and it really helps. And ultimately, in the context of the EU, you could think as a final step on top of that, to also think about a European scheme. Now, what we've seen when we studied the public-private partnership schemes is that the latter also works the other way around. If you have a national consciousness in the government or at EU level in our case, but you could also start at the national level, that you need to do this, then government can already incentivize coding, building codes, how you license, but also how people maybe need to take up insurance or at least campaign for that, communicate about that. By doing that, they can also support insurance, because what we see is that in those countries where there is a public-private partnership, the uptake of insurance in general is bigger. And when insurers are more involved, that benefit is not only that they pay for damages, and frankly, they do a lot more than paying. They support people in their process. They are a way to reach people because they have the contact. But they can also ex ante help to mitigate and adapt. And finally, mitigation and adaptation can happen more. So for us, the ecosystem of all these players clearly shows that they all need to act. Now, there's a bit of maybe a first mover disadvantage. That's why EIOPA keeps providing proposals and options. And also here, I'm very interested to see what is going to come out from the European Commission. And we will hear from the Commissioner later on. They are working on a climate resilience proposal. DG Climate working very hard on that. So I'm also looking forward to that. But I also know that there are many initiatives in the member states at the national level. But nevertheless, that doesn't mean that if politicians are thinking or supervisors are, because I know the majority in the call is the industry, that industry should not just think about what others should do, but also what they can do. There is too little uptake of insurance. There is yet very little incentivizing of mitigation adaptations when people buy insurance products. So also here, what can you do to make sure that more people get the insurance and that we keep it affordable and available, because we need that.
Thank you, Peter. Very clear message. So everyone has a role to play, and insurance certainly has a key role to play as well. Not alone, but we should start going beyond just looking at the others and start acting together. Thank you so much for your words, for sharing your thoughts with us. And thank you so much also for the speech and for opening in such a great way our event today. Thank you, Petra. So with this, really setting up the scene from the start, really a good start. Let's then move to our next keynote. So as I mentioned, this will be a recorded intervention, but we are very happy to have Commissioner Hoekstra, the Commissioner for Climate, Net Zero and Clean Growth, was kind enough to share some words with us that we will now broadcast for all of you, also on the topic of this event. So let's play the video.
Ladies and gentlemen, thank you for inviting me to address you today. We must not have any illusions about the impact of climate change. Climate change is an economic and a security reality, with unfortunately decades-long implications. And in all likelihood, it will get worse before it gets better. Across the European Union, across Europe, we're seeing more frequent and more intense extreme weather events, from floods and wildfires to heat waves and droughts. Many of you here today know about this all too well. You see this growing reality reflected in claims, in pricing, and in insurability itself. You are facing the challenge of the climate protection gap, which is unfortunately unacceptably wide today. On average, just 25% of European assets exposed to climate extremes are actually insured. So what are these solutions and how do we take this forward together? First, let me reiterate, your role and your expertise are absolutely critical. Insurers and pension funds are not just exposed to climate risks, you're also central to how we manage them. Because you assess risk, you price it, and you absorb shocks. And increasingly, you actually do shape behavior. So you have a huge influence, and you're an active partner in prevention and in resilience. When insurance products reward resilience, for example through lower premiums for climate-adapted buildings, they send a clear signal. And when climate risks are embedded into underwriting and investment decisions, they do drive better choices all across the economy. But we also all know the reality. Risk awareness alone is unfortunately not enough. We must take action to reduce risks, to limit damages, and ensure that our economies remain not only competitive, but also insurable. And this is exactly why we're developing a European integrated framework for climate resilience. It is a strategic priority for us here in Europe. And its objective is simple. We want to make Europe significantly better prepared for climate impacts than where we are today. And we want to embed climate risk considerations into decisions across all sectors, including, of course, finance. And we want to move from reacting to disasters to anticipating risks and managing them much more proactively. And this means integrating forward-looking climate risk assessments into policies and into investments. It means clarifying risk ownership. And it means embedding the principle of resilience by design, as we call it, in our policy and decision making. Now, in practice, we're going to have to design infrastructure, assets, and financial decisions for the climate conditions they will face over their lifetime, not those of the past. Ladies and gentlemen, we're developing this framework in very close dialogue with stakeholders, including many of you here today. And the recent public consultation gave us some clear messages. Stakeholders highlighted the need for better access to local climate data and risk information, clearer insurance products, including on hazards covered, and stronger integration of climate risks into financial and accounting frameworks. But of course, there's the big question of how to finance it all. And here I am very grateful for all the input by the Reflection Group on mobilizing climate resilience financing, where some of you have participated. And to me, the takeaway is clear. We all have a role to play. Government, supervisors, business, in turning these plans into action and into reality. Public authorities can provide forward-looking risk information. They can provide and create enabling frameworks, and they can facilitate access to financing. Yet at the same time, private finance, including insurers and institutional investors, can help to scale up investment in resilience infrastructure and in services. Ladies and gentlemen, climate change is one of the defining challenges for our generation. It is truly testing our ability to anticipate risks and collectively build a more resilient future. So let's make sure we rise to the challenge. Let's make sure that our economies and societies can continue to thrive in a changing climate. for our own sake, but of course also very much for the sake of generations to come. So thank you very much, and I wish you a day of truly fruitful conversations. Thank you.
Okay, so we thank you, of course, to the Commissioner for sharing this also very interesting speech, his words really, again, emphasizing quite some important messages around the importance not only of resilience for Europe, but also highlighting, of course, the very central role that the insurance and reinsurance sectors play in delivering on this strategic objective for Europe, as we heard. So we all look forward to the integrated framework following the consultation. We all look forward to the proposals. And of course, also from EIOPA side, we are standing ready to support in achieving this strategic objective, which is very much aligned with much of the work we have been developing. One of the points that Commissioner Hoekstra mentioned is precisely related to the NatCat insurance protection gap. And this is an interesting and important segue to our next point on our agenda, which was also already mentioned by Petra in her opening remarks. We have been working together with partners on this topic of the natural catastrophe insurance protection gap, and from different perspectives, what can be done to narrow this gap. And so our next topic will be a panel discussion precisely focusing on the most recent publication that we have issued at the beginning of April, so very recent still, together with our colleagues from the European Stability Mechanism, further exploring this aspect of how can and to what extent an European approach contribute to natural catastrophe risk management. How could it be designed? How could it, in a sense, help us promote availability and affordability of insurance and narrow these gaps? So without further ado, I would hand over the floor to our colleague Bernard Meyer, who is a financial sector principal from the European Stability Mechanism, and he will moderate this, I hope, very interesting panel discussion. So the floor is yours, Bernard.
Hello, everyone. Thank you very much for the nice introduction. I have the honor to moderate today's first panel with the title, What are the benefits of a European approach to natural catastrophe risk management? In this panel, I have two distinguished speakers. Patrick Hötjes, he is the head of the Policy and Supervisory Convergence Department at EIOPA. His department focuses on prudential policy for both the insurance and the occupational pension sector, the convergence of supervisory practices through various tools, sustainable finance, pension oversight, international activities. Then we have Rolf Strauch. He is the chief economist and managing board member at the European Stability Mechanism, and he is responsible for economic and financial analysis and policies and the country monitoring work that the ESM is undertaking. Patrick and Wolf will talk about the recent EIOPA ESM collaborations on insurance protection gaps, which culminated in the staff paper that Carlos was just referring to. And we called it Sharing the Risk, a European Approach to Natural Catastrophe Risk Management. As we have seen in many recent devastating events, be it Dana, the floods in Valencia, or the floods in the Ahr Valley and the neighboring countries, natural catastrophes pose significant economic and societal risk across Europe. Still, there is growing exposure and insurance coverage appears insufficient, leaving all individuals, businesses, governments vulnerable. The recent EIOPA ESM publication offers an example on how one could address the issue. It blends the earlier work of the two institutions and explores the benefits of European risk-sharing mechanism that combines a natural insurance catastrophe insurance pool with a loan-based backstop mechanism. But before we go into a more detailed discussion on this topic, I would like to run a short poll among the audience with the question, do you agree that we need a European risk-sharing mechanism? Can someone put up the poll, please? So you can see it now. We have questions are the possible answers. Yes, such a complementary measure will make the community more resilient. No, not now. We should wait until a scheme exists in every member state before implementing an EU-level mechanism. No, the issue needs to be solved at national level, or still unsure. So far we seem to have a relatively clear response on this. Still unsure is 9%, 69% at the moment for such a complementary issue will make the community more resilient. Okay, so it seems that the results have stabilized now. The majority view, 2/3, is that such a complementary measure will make the community more resilient. There's also quite a substantial number of people that are still unsure, and some saying that we should not have a mechanism introduced right now. So hopefully the discussion that we are going to have right now will help further clarify and give additional certainty on how such an approach could work and where one could see the benefits of such an approach. Maybe let me turn first to Patrick. Why do you come out with this paper now? Does this build on EIOPA's previous work? And also, do you see, is it important to have a system function in every member state, relating a little bit to the question that we also asked in terms of should it be based on something that already other countries already have, or is it something that can be developed separately?
Thanks, thanks, Bernard, and also thanks for the kind introduction from your side. Yes, of course, this is based on, you could say, previous work that we've done in this area. I think it was already referred to also by Petra in her speech, right? The work that we did in 2023, I think, laid the foundations together with the ECB. And I don't think we can repeat this often enough, but that introduces this ladder approach. And I think that's important because indeed all the actors, you could say, in this in the environment, they need to participate, they need to cooperate. And I think another important element that Petra already clarified is that this ladder approach, it works, of course, upwards. So it needs the bigger risks, the bigger the players that need to be, you could say, incorporated, going up to the national level and then even to the EU level. And there are clear benefits in each step. Also, then going down back into the other layer. So it's a two-way street in a way. It impacts in both directions, and that's why it is important to, you could say, have not only a national solution, which you do need. We really think that that is also a foundation on which you can then build on top of that, you could say, an additional layer. I think also Rolf can explain also maybe much better how those mechanisms then also in terms of the actual costs of maintaining such a system will reduce the overall cost in the system. So not only, you could say, it provides, you could say, the final backstop and final coverage, but it can also reduce overall the total costs that are generated by these increasing risks. Because I think that was another important element that I wanted to emphasize. And I think Commissioner Hoekstra also said it very clearly: more frequent, more intense extreme weather events. And it's not only about, you could say, having them insurable, having them affordable, going longer forward, but also how do we then reduce the risks? And I think that's the second point I want to reiterate, and maybe also there I will come back again and again. It's about incentives. So how do we bring incentives into our financial system that actually help us to prepare better, to be better in mitigating risks in advance, instead of, in the end of the day, footing the bill afterwards? And these mechanisms all play a role in bringing them, you could say, more affordable, but also bring the incentives into the system by which we can actually reduce the risks also going forward. So that's why we are doing this work now, because it's an urgent issue. It is a growing issue. It is of financial stability interest, but also on consumer protection, which was also already mentioned by Petra. So we do see the risks now. We see the risks increasing. So EIOPA is working on those topics from a purely technical perspective, and we hope that our contributions really help also to move the debate forward.
Sorry, Bernard, you're muted, I think.
Yeah, thanks for this, Patrick. Financial stability obviously is one of the key points that we want to talk a little bit more in detail now. So we know obviously the EIOPA's role in monitoring the risks that insurers face, but why is DSM interested in this topic? And that would be something that I would like to ask Rolf. So can you elaborate a bit on the financial stability angle in this? Why are we looking, why is the ESM looking into this? And also the backstop facility that is discussed in this paper sounds a little bit like an abstract concept. Could you provide us a little bit more detail on what it means and how that should work in practice? Thank you.
Yes, very much. Happy to do. Yeah, ESM is a crisis resolution mechanism. Our main concern are financial stability risks for the euro area and its member states. And this topic links to financial stability risk in a sense that major disaster is a shock, an economic shock and a financial shock to a region and maybe to a country. And that obviously raises risks. And our concern is not in a sense that we see there an immediate crisis around the corner at this stage, but we want to contribute to that discussion in a preventive manner, also addressing those risks that are emerging with the increased impact of climate change. And from that perspective, there are a number of points that have to be mentioned. And I think the key factor is that when a disaster occurs, then people generally look for help. And it is part of the political economy of such an event that when it has happened, governments tend to step in order to provide support. That somehow also distorts incentives, because what happens is that the consequences of the disaster are socialized and generally the taxpayers have to pay for this. And if the damage is big, that may not be easily the case. So governments may have to raise debt. Markets may have to believe that this is digestible for the government and the government can actually get out of that debt. So there are a number of factors here where you need to have market confidence and market trust in such a stressed situation. And it's much, much better to avoid it and to think upfront how the situation can be dealt with and how you can actually mitigate the impact. And that brings me to the second point, because the empirical evidence is that if there are insurance systems that cover natural disasters, it shows actually that the recovery is faster. The help flows faster. The economic consequences can actually be mitigated much better, so that the overall loss can be reduced. And that is obviously an important element for us also to think about such a mechanism in order to stabilize, in order to create resilience. That affects the economy per se, the regional the firms that are in that region, employment that is generated in that region, how attractive the region is for tourists, and all that. So the recovery will be faster. And it affects, and here we come again to financial stability, it affects also the financial system, it affects the banks. Banks, particularly local banks, have often very localized risk. That means if such a disaster happens, then it's really also the financial sector in that area that loses a lot of assets and that faces problems. And again, if these damages are insured, there is an easier way out. In a way, there's more collateralization for the banks. They're in a safer grounds. So there are various mechanisms that add to the financial stability aspects and risks of such a situation when strong disasters occur. And that is why it's so important from our perspective to think upfront how we can help and what it can do and what it actually does. Why is there such a common backstop? And here the idea is essentially built on what we also have created for the banking sector, that if you have a pool of resources at a European level, it diversifies risk. There may still be extreme events where it makes sense to have a public backstop to such a pool of resources, because that helps to lower costs and transform risks over time, allow for a longer repayment period. And that is, I think, essential in order to make this a scheme that is also more affordable for the private sector and therefore able to insure more risks. This, I think, is roughly the idea behind the proposal of creating such a backstop.
No, thank you very much, Rolf. I think that's very helpful to get a better understanding of how the mechanism works. Now, we have seen a couple of papers in the past and also responses to this recent publication. And there's the concern is, why is this paper focusing on insurance capacity only? Isn't there also not an aspect to think about the demand side as well? And to what extent is the demand side not also a very important aspect we could consider in when we look into natural catastrophe gaps? Maybe Patrick, you want to start?
Thanks, Bernard. Yes, it is an important element. Again, think about the ladder approach there, and indeed the way that it works in both directions. Now, the starting point is there is a significant insurance protection gap, and it's significant worldwide, but in Europe it's really, really big. And I think it's something that we want to address and must address. And there are many reasons why that is so. So we also are looking at, you could say, awareness, affordability, availability of insurance solutions. So there are all, you could say, contributing factors to the existing gap on the demand side. I think another element, and I think that was also something that already Rolf touched upon, of course, there is also something like an implicit guarantee already now into the system. So one of the reasons why there may be a low incentive to take up insurance is the idea that if disaster strikes, which we as individuals always tend to think it will not happen to us, right? It will happen to other people, but not to us. When it will strike, there is always the government that will step in, that will come to the rescue, that will surely not make all these costs only bearing on my own shoulder. So what we are doing with this ladder approach is to, you could say, bring the risk incentives into each layer, so that in each layer people understand much better what the risks are that they're exposed to. And for instance, also on the demand side, EIOPA also has developed, you could say, proposals, tools to address that, but it's to bring in each of the layers these incentives much more clearer to the ones that can bear the risks. And in that sense, when you understand the risks better, you're also much earlier inclined to take actions to lower those risks. Whereas if you could say, are leaning a little bit back and think it's someone else's problem, and this is unfortunately something that we hear a lot, it was also referred to earlier, we are doing fine, it's the others that should move. When that mentality maintains, then at the end of the day, not a lot will change. And with increased events, increased intensity of events, we will reach, you could say, levels that it really starts to impact the functioning of, you could say, economies as a whole. I think in some of the areas in Europe, we're already running those risks because we have big states that have a diversified portfolio of catastrophe risk, but we also have small states that are, you could say, singularly exposed to one large risk. The capacity for those individual states to bear those risks going forward is a big question mark, also with all the other budgetary demands that we have in our current geopolitical environment. So in that sense, yes, it's not the silver bullet. We keep repeating, it's a ladder approach, but it helps from the top down to bring the risk incentives in and then let them trickle down into the system. So at the end of the day, in each of the layers, you need to do something. That's our firm belief.
Yeah, I can only subscribe to that. Demand measures matter a lot and should be taken. And here, not only related to awareness, but also measures on the public side, on the private side of mitigation and adaptation. That is obviously absolutely crucial. But in writing the paper or in studying the aspect, you need to decide what you want to look as first and foremost. And then was a decision to look at this capacity aspect, essentially in order to try to what one can also characterize as a market failure, as was said, also indicated before. If prices don't match, then there is no market, then there is no clearance. And if indeed the price that insurers or reinsurers would need and want for the insurance of extreme risks is too high for what households not only are willing to pay, but maybe actually able to pay, because also households are resource constrained, then there is no clearance and then there is a gap. And this is precisely the point, I think, which should be addressed here and which is addressed here by looking at this capacity and looking at it and trying to design a mechanism that makes it simply manageable without deferring the costs again to the taxpayer, but keeping the cost in the system and make it payable.
No, thank you very well, Rolf and Patrick. We have a lot of questions from the audience, but before we go to that, I have a final question to you in regarding what's the next steps. So what are your plans after this? Are you addressing decision makers for targeting particular policies, or what are your plans in this respect?
Yeah, thanks, Bernard. Of course, we're not politicians. We have to emphasize that. So we are in this game because we see the risk and we want to provide, you could say, the technical evidence hinting at the solution. So what we all will do and will continue to do is work on all the areas in the letter. I think with this particular piece of work that we did now together with the ESM, I think we have laid a very clear foundation, which I think can be picked up and hopefully also brought further at the political level. And as always, we are standing ready to support that process. We are, of course, a body accountable to the Council, to the Parliament. So we're always stand ready to provide further advice when that's needed. But we'll also continue to work on all the other areas. I think the element also even on the policy side, Solvency II was already mentioned. We have also a proposal out that is also, you could say, in the public domain on a tool to increase awareness, the Protect tool that we developed. And we're also thinking about, you could say, in other steps of the ladder, further work that we can do from our side. So we will not rest here. We will continue to work on the topics. But I think with this particular work stream, I think we have a clear and well evidenced and technically sound work that hopefully can be picked up going forward by those that need to take the actions also at the political level.
I think indeed the role of ESM, the role of EIOPA, the role of European institutions is being thought leaders in the field of their expertise. And that relates to insurance, and for us it relates to crisis management and crisis prevention. And the paper has to be seen exactly in that context. It's a contribution to discussion. How that discussion will evolve and how it will later on politically build on those insights that are provided, that has to be seen. And that's not, we aren't here not in the driving seat, but that will, the political discourse and policymakers will have to decide.
No, thank you very much. Maybe I'll turn now to the first question that we have received. So how can insurance coverage be encouraged and supported among the population? Is mandatory insurance the only effective policy instrument?
Thanks for that. I think this is more related to me as it's going in the direction of insurance. No, we don't advocate for mandatory insurance. Of course, it can be a solution because I think one of the elements of availability and affordability is, of course, if you have a large coverage, then you also have a large diversification of risk, and therefore also at the end of the day, prices will become more manageable. So yes, it can of course provide solutions in certain markets, but it's not, you could say, the solution that we would advocate from our side. I think it's important to find mechanisms in your market that indeed increase both the availability of insurance solutions. And I think our work that we're discussing today on ESM, EIOPA proposal, does exactly that. but also you could say on affordability of these products, and at the end of the day also on the awareness. And I think also there, if you build incentives into your market by which people are much more aware of the risks that they're running and of the solutions that they can actually take themselves to lower those risks, and maybe also with financial incentives coupled with that, have a trigger to do so, have an incentive to do so. That's the way forward from our perspective.
No, thank you very much. And another question was, how would the proposed EU-level pool ensure that it complements rather than weakens risk-based pricing and private reinsurance, particularly in high-risk regions? So the question really is this really a complement, or is it replacing some of what measures that are already in place or systems that are in place? Maybe Rolf, you want to start on this?
Yeah, happy to do. That's a design feature that one can structure. And here you can have basically also the backstop as a reinsurance mechanism to reinsurance, a reinsurance mechanism or a mechanism that supports and steps in complementing national mechanisms that exist, or if that were the political will, replacing them, because that would straightforwardly take the risk to the European level and make it more diversified. So this will be part of a policy discussion, how you want to structure it in order to be able to actually cover this without overburdening individual countries and without overburdening individual insurance sectors. That's the point here. We want to have fiscal neutrality. This should be covered, eventually covered by the insurance industry, and it must be covered in a way that the industry can digest. And here, European diversification, I think, is a big plus. How this is precisely done, again, it will have to be featured. And let me also make a point here on when you say regionally concentrated risks and the possibility of moral hazard. I think that's also something that one can design and think about, and certainly in a political discourse would be addressed. What are the conditions for contributing and participating in that mission, in that backstop mechanism? Also, that can be designed, and we know that in the banking sector, for example, there is common supervision that helps ensuring that there are common standards. Here, we may have other mechanisms that really help also, that governments do the necessary steps in mitigation, that other steps are done in demand management, so that there is kind of a more common playing field in order to join that mechanism.
Thank you. Then another question that goes more towards the price of insurance. So what about if the price of insurance is too high for the individuals, or in the case if the insurance doesn't want to insure certain geographical parts, or if they don't want to insure certain risk at all? In this case, the government has to win, or is there any other solution to this? How do you deal with that if people do not pick up the insurance, or insurers simply do not want to get engaged in a certain area or region of Europe?
Thanks. But I think it's important that, yeah, it's a good question, but of course you need to understand the specificities of each of that situation, right? Because there can be many reasons why the pricing is too high. And indeed, if there is, you could say, a natural selection that only people that are exposed to large risks want to do an uptake on insurance, yeah, of course, then you have a small pool, you have large risks, then there will be high prices. I think that's an element. But of course, it can also be an element at the end of the day where you do have a large diversification, you do have this risk incentive, and you still have high prices. That can be indeed an element of, you could say, just a reality that we also need to recognize. And I think in that sense, building these layers, the sooner you build them, the better, because they will impact on each of the layers, you could say, the risk awareness, to a point that we can also avoid future risks growing. And I'm thinking, for instance, about building codes that was also referred to earlier. They may not reflect currently correctly all the net cat risks that we are exposed to in certain areas geographically. And then we continue to build, we continue to invest, whereas we know that at the end of the day, the risks can actually become quite intense in those areas. So we need to make sure that we keep affordability, but that only works if you identify the risks upfront and are able to mitigate them in advance. So yes, there is an issue on affordability, there is an issue on pricing. There are many ways to address that by having a larger pool, both at the national level and ultimately at the European level. That will help bring down the cost. Also, as Rolf mentioned, design features, key word there. Make sure that it is designed in such a way that it indeed lowers, that it incentivizes mitigation and it lowers, you could say, this moral hazard. But at the end of the day, we also need to realize that the fact that we have climate change, that we have increased intensity and increased frequency, has an impact ultimately also on our economies. We need to adapt, and that also will come with some costs.
No, thank you very much for this very interesting discussion, Rolf and Patrick. Time flies, and it's already the end of this presentation. I think we will probably have a lot of opportunities in the future to discuss with the industry and regulators developments, and I'm sure this will not be the last time that we speak to this. And with that, I will head back to Carlos.
Great pleasure. Thank you.
Thank you.
Thank you so much, Bernard. And of course, thank you also to our panelists for the very interesting discussion. Thank you very much. And I think in this discussion, which was brief, unfortunately, we thank you all for the many questions. Unfortunately, we don't have the time to address them all on this live discussion, but thank you so much for actively engaging with our panelists. But looking at our next topic, one of the points that was, of course, highlighted in this discussion was the role that these European mechanisms could potentially play, and that's the way we advocate they should be designed in terms of creating incentives. Patrick referred a number of times to risk reduction, risk-aligned, risk-based incentives. So I'm happy to introduce our next speaker, Marie Scholler, who is a senior expert on sustainable finance at EIOPA. And she will present to all of you a very interesting, well, that's a bit maybe my personal opinion, I hope you will agree with that, recent publication that we just consulted upon, precisely related to this aspect of how these incentives are then picked up in our prudential framework, Solvency II for the Nat Cat. So looking forward to your presentation, and I hand the floor to you, Marie.
Thanks a lot, Carlos. Good morning, good afternoon, good evening, everyone. It's a pleasure to be here and to talk indeed more about the need of adaptation measures. To start this presentation, I would have a Slido question to you to get a bit your feedback and better understand from your perspective to what extent do you think that adaptation measures are already integrated into underwriting decisions? And do you think, well, actually, this is not the case at all? Or do you think somehow yes, but very moderately? Is it already significantly included, or actually it's a key requirement in any insurance product? And I will give you some time to respond to this question. And while you do so, I will go to the first slide, presenting a bit the background of this work, and then I will go back to your responses to see a bit what were your insights in this question. So a bit more on the background of this work. I think it's quite clear from this conference today that the work EIOPA is doing, has been doing in the last couple of years on the insurance protection gap is very key, because we have a significant insurance protection gap for natural catastrophe in Europe. And so we have worked on different ideas, solution, analysis to see what we can do. And one of them is this concept we have introduced for a while ago, which talks about the concept of impact underwriting. And what do we mean with that? Well, we really think as EIOPA that it's extremely important to think about what can I do, what can we all do to reduce potential future losses? Because this is very important. We want to keep insurance affordable, insurable, also going forward. We need to really think more about risk mitigation measures. And this is really why we had initially introduced this concept of impact underwriting, which also highlights the clear role that the insurance and the reinsurance sector can do to actually contribute to this advisory role to help policyholders to adapt to the risks and maybe not just come when a claims happened and then it needs to be paid. This is maybe too late, but really act as an advisor for their policyholder. So this is really this concept of impact underwriting. And so we have been discussing that in previous publications and also looking at already a bit in the prudential treatment of sustainability risks. We were also looking at the premium and the reserve risk module. And in that paper, we also clearly saw that there would be the need for further discussion, further analysis, looking at the natural catastrophe module in the standard formula, so really from a capital requirement perspective. And this is what I'm going to discuss with you today. Also to highlight, of course, I think we have seen it also from the previous intervention, the clear focus also that the European Commission has on this topic of resilience, also with the resilience integrated framework, where we will know more by end of the year, and also focusing on this insurance protection gaps. So we see with this, we very much align also with the European agenda. So that's why today I'm here to talk more on this work we have done together with the national insurance supervisors, looking at the prudential treatment of adaptation measures under Solvency II in the natural catastrophe module. But before I continue with the rest of my presentation, I would be curious to see what were the insights we got from the people in this call to actually to what extent are adaptation measures integrated in underwriting decisions. And I think what comes quite clear, and it also fits well with also previous analysis we have been doing to see to what extent they are integrated in underwriting decision. It seems that it's quite moderate at the moment. We also have quite a few people who responded that it's actually not at all. And well, very little people say that it's a clear core requirement across all products. And I think this is exactly what we want to see more in the future, and also why we have been working on the paper that I'm presenting to you today. So now I would like to continue with the presentation and to go a bit more in details about this work that we have just had under public consultation. So what was the work about? I think the work we have split it in two parts. The first part was really looking at the current prudential framework. So how do we today calibrate the parameters for the capital requirement of the natural catastrophe module and better understand how adaptation measures are reflected. So that was the first part of the work. And then in the second part, we actually discussed if there is a gap, and also if we should think of different options on how to better reflect prudential measures in the capital requirement for the natural catastrophe module. So this is the second part of our work. Another important message also that I had today was to mention that we wanted to look at both the macro measures. So what we talk about macro measures is really these large-scale flood defenses, for example, that are extremely important to mitigate future losses. And these are typically more financed from public authorities. And we also discuss the micro measures. So really, what can we as individuals, all of us, do to actually also reduce potential future losses to our houses, for example. So we are looking in this paper at these two elements that are extremely key to mitigate losses. So if you go to the next slide. So what is the paper about? As I said, we started to really look at how the parameters are today calibrated in the standard formula, and to have a look at how adaptations are reflected. To calibrate the parameters in the standard formula, we are using catastrophe models. And there we really wanted to better understand how these catastrophe models actually are able to capture adaptation measures. So that was the beginning. A second step was also to look at materiality. And I think this is extremely important in this type of work, is always to have first an assessment also, well, how material this problem is. Of course, when we look at the standard formula, we already have some materiality step, if I may say so. Of course, the risk to be able to have a parameter in the standard formula, the risk needs to be relevant. So let's say earthquake risk. And then you also need this risk to be relevant for the insurance sector. So you also need to have sufficient insurance penetration. So this is already the materiality steps, I would say, to have a parameter in the standard formula. But what we also looked at in this paper is also when we think of adaptation measures, this can go in many different directions. There are many different ways to adapt. So we also thought, okay, should we also in this paper discuss a bit maybe between different perils, also always staying in this context of the standard formula, are they maybe some periods where we would focus more from a standard formula perspective when we talk about adaptation, for example. So this is also an exercise that we try to do in this paper. The third element, and I will go a bit more in details in the next slide, is also then to discuss potential options to maybe better reflect adaptation measures. And this is an exercise we have done together also with the national insurance supervisors to brainstorm this on different options, possibilities. And you see also in the consultation papers, we also discussed pros and cons of each of these options. And finally, the last part of the consultation paper was also providing a quantitative assessment, because I think this is extremely key when we talk about, well, adaptation measures. We need to have data and we need to have models that are able to capture the impact of adaptation measures, and we need to have more of that. So also in the last part of the paper, we started with looking at different perils and trying also to do some impact assessment on what is the impact of these adaptation measures for the future losses. So now on the next slide, I would like to go a bit more in details in the different options that we have been presenting in the consultation paper. And let's start with the first option, which discusses the usage of the regular reassessment process that we have for the standard formula for the natural catastrophe module, and use that to be able to actually have a more thorough analysis on and ensure that adaptation measures are well captured in this exercise. So we have EIOPA received recently a mandate from the European Commission to do a more regular reassessment of the standard formula, because, well, if you had a look at these parameters, you could see that sometimes they were the same for quite some years. And of course, now with the science evolving, with climate change, it's a very dynamic field. And also we have to make sure that the parameters, they stay accurate through time. So we have now this more frequent reassessment process in place. And there an option could be to ensure that, for example, the catastrophe models we are using are well reflecting the macro adaptation measures. So that could be one option that we are discussing. The second option was to then go a bit more in details and look if this concept of undertaking specific parameters could be used to also better reflect adaptation measures. So we have the standard formula already uses this undertaking specific parameter, for example, for the premium and reserve module. And there, why not think if you could use some similar concept to reflect adaptation measures and really have the companies being able to use their own data to actually calibrate the parameters to better reflect adaptation. So this is also something we discussed. The third option we have also presented in the paper was using this concept of risk mitigation. So in Solvency II, there is already this concept of risk mitigation that is used today. And we thought, okay, could this also be something for reflecting adaptation measures? Of course, I think what is important, we are in the context of Solvency II. So also there, for example, risk mitigation is used for a certain purpose. It's typically used to reflect a risk transfer mechanism. And maybe this is not exactly aligning with what we have in mind with adaptation. So again, we're also discussing this option. The fourth element we wanted to bring then also in the discussion was, well, should we think of a possibility to add a new parameter in the standard formula? Because currently the parameters, they are calibrated to reflect average market conditions. And should we think of having maybe a second set of parameters that would actually be calibrated and would reflect a portfolio with a lot of adaptation measures, for example? So this is also something we wanted to bring to the attention in the consultation paper. And maybe the last element we have brought also in the discussion, and we found it also important, while not, of course, directly as the other options discussing more the standard formula, but we thought, well, in this topic, it is also extremely important to think about internal model, because typically internal model, they might also be able to reflect very granular data and so on. So maybe they would be also very adequate to think of better reflecting adaptation measures also in the usage of internal models. But also there we acknowledge this is maybe a last consideration we wanted to have in this paper, because we found it very important, but yes, indeed, it would not directly relate to the standard formula. So if we can move to the last slide that I have for you today. So as we said, we had this paper under public consultation until the 17th of April. And what we are currently doing now, we are considering all the feedbacks we have received from you. So of course, I can imagine that many are also listening to us today. So thanks a lot for the feedback that we have received. And we would like to use that to finalize the paper. And the aim is to publish this paper by end of the year. So thank you very much for your attention. And I think, Carlos, maybe there is a bit of time for 1-2 questions.
Yes, thank you so much, Marie. Very interesting presentation, very interesting topic. Indeed, we keep talking about incentives, we keep talking about risk sensitivity, but okay, let's start looking at Solvency II and where we are there. So indeed, we received a few questions. Maybe we have time to cover 1 or 2 of those. One question that we received, which I think you could expect might be raised, Marie, given the discussions we had so far, is raising this point that, of course, climate adaptations are not all equal. They are not created equal. The way you can have a similar exposure, similar insurers, but then with completely different adaptation measures in place. So in a sense, how do we cater for this heterogeneity? How do we cater for this aspect of these individual circumstances? How is this considered in the consultation paper?
Yes, no, I think that is, of course, an extremely crucial point, and something we have also discussed a lot when we were working together with the national insurance supervisors on this option. I think this would maybe relate more also to the option where we would potentially think of creating a new parameter to account for adaptation measures in the standard formula. And there we clearly have recognized the challenge that indeed there are many different adaptation measures. So it would be extremely key to define which type of adaptation measures we are looking. What we have also heard also when discussing this topic with different stakeholders is the need to have maybe something more structured, really highlighting, okay, maybe there are some adaptation measures where the impact is more significant. Should we maybe prioritize this one? But of course, this if we would be going forward to calibrate such parameters for different adaptation measures, I mean, it would be very crucial to work with experts from the industry. I mean, we already work with the external network of catastrophe risk, where we have members from the insurance sector, but also from the commercial model vendors, for example, to work really together to define some standards around that. And I think that would be quite a challenging work to do.
Yeah, no, indeed. Thank you, Marie. Of course, the challenge is significant, but also I think this is exactly what we need to look at if we want to be consequential on all this discussion, that these incentives are not only in the products, in the underwriting, but then there's also, of course, a way to reflect this in the capital calculations. Maybe very briefly, we got a few more questions, but very briefly, we just ended the consultation around 10 days ago. And I know, of course, we are still going through the details, usually very rich feedback we receive. But there is a question asking specifically if we got any feedback so far from the standard formula users, because this is the ones we are addressing. If we have any feedback in terms of an idea, what kind of impact could such change potentially have in the insurance pricing, in the way, in a sense, could this contribute also to make insurance more affordable to the policyholder in the end? Do you recall something along those lines from the feedback or the discussions?
I mean, we have just started to look at the feedback that we have received. But of course, I think the aim of this work is, well, to see if we could better incentivize and better account for adaptation measures in the capital requirement. And by doing so, hopefully it would also encourage the further discussion, also looking at the impact then on premiums and so on, and hopefully have a positive benefit for all of us. But yes, indeed, that's maybe a very important element to highlight, as also was raised before by Petra and by all of us. I think this work clearly highlights the fact that we at EIOPA, we are very serious of looking at this concept of impact underwriting and really trying to think, okay, within our framework, what can we do to further incentivize this need for more adaptation measures? And yeah, we have the capital requirement, and that's what we discuss in this paper.
Okay, thank you so much, Marie. Thank you for the very interesting presentation and, of course, the work that underlies this presentation. And for all those that listen to you today, I'm sure they will be eager to see where we go from as a next step. So thank you so much again. And yeah, we will continue, of course, following this very relevant topic. So this brings us to also an important moment in our event, to the coffee break. So we will break now for approximately 15 minutes, sorry, and we will resume at 11:20. So take this opportunity to stretch your legs, grab a coffee, a tea, as you prefer, and we hope to have you there again when we resume at 11:20. Thank you so much. Okay, welcome back, ladies and gentlemen. Thank you for staying with us. I hope you enjoyed this moment, this short break. And now we resume our program with, I would say, a core element of our discussions today, which links directly to the motto of our conference, as I mentioned this morning. It's about insurance, but it's also about innovation. And the next panel will aim at bringing these two together and explore how these two transitions can operate, how they can support each other, but also the challenges, of course, that this may create. To moderate this panel, I'm very happy to introduce my colleague, Valérie Marriott-Wood, who is the head of Consumer Protection Department at EIOPA. And in this role, she is in charge, among many other things, in a very busy portfolio of the digital finance aspects. So very much welcome, Valérie. And I think we all look forward to this discussion, and I hand over the floor to you. Thank you so much.
Thank you very much, Carlos, and good afternoon to you all. Now, allow me to briefly set the scene before I introduce the speakers for this panel on the role of technology in a greener future. Now, technology is reshaping sustainable finance from different perspectives, whether that's the identification, the measurement, or the management of sustainability risks in the insurance sector. And in particular, digital innovation, so that's generative AI, data analytics, blockchain, Earth observation data, etc., has the potential to significantly enhance transparency, accountability, and reporting. And technology can also foster more sustainable underwriting or claims handling, also investment practices, as well as support innovative supervisory approaches. Now, this panel will focus on the opportunities and the challenges arising from the transition to a more sustainable economy. And it will highlight the benefits and opportunities, but also the risks that technology brings about for the different stakeholders. So that's supervisors, the private sector, but also consumers. And in this panel, we will talk about how data analytics can improve risk identification and management. And how good is sustainability data right now? I mean, is sustainability reporting fit for purpose even? But we will also discuss how supervisors and public authorities use digital tools and data to monitor risks, support financial stability, and protect consumers. So we will talk about prevention and adaptation as well. We will also talk about protection gaps and how technology can help close these gaps. And you will remember Petra mentioning that 3/4 of natural catastrophe-related loss in the EU have remained uninsured over the last decades. But we will also talk about risks. For example, greenwashing and the reliability of sustainability metrics. So to explore all of these thorny questions, I will be enlisting the skills of my 4 distinguished panelists. So on the industry side, Laurent, who founded a startup called Mitigate, specialized in flood prevention analytics. Representing consumers, we have Paul. So Paul is the vice chair of one of EIOPA's stakeholder group. And on the side of supervisors, we have Teija, who on top of her role at the Finnish Supervisory Authority, is a member of EIOPA's management board. And finally, Fiammetta from the EU Space Programme Agency. And with EU SPA, we will learn about the EU's tech capability and evidence infrastructure. Now, having defined our roadmap, let's get started. And to ease us gently into the discussion, we will start with a little Slido poll. So if you could put it on screen, please. So the question is about financial innovation. So that's the financing and how it can best boost resilience and support the green transition. So should it really go into data and AI-driven solutions? So we will explore later using satellite data for predictions, but also for claims. or other tech-driven resilience. So that could be early warning systems, alarm systems, reusing water, filtration, protecting coastlines, etc. But also nature-based solution. Let's not forget, this is about reforestation, using mangroves as natural barriers, or using resilient crops, developing resilient crops. So we will leave this there for the time being, and we will review the results at the end of the first round of discussion with the panelists. So without further ado, let me open the panel, and we will start with the first question. And the first question is to each of the panelists whether they think that using digital innovation in insurance and pension is a net positive in lowering the risks from climate change and nature loss. And I will start with Thea, if that's fine. And Thea, so supervisors tend to be quite conservative in their approach to risk assessment. So would you see a role for technology and innovation in supporting supervisory activities related to sustainability risks and climate change in particular? We can't hear you.
Yeah,
there you go.
Time right there. Yeah, thank you. Thank you first for inviting me to this panel. Yes, I think that supervisors shouldn't be too conservative at this point. So when innovating and developing new tools, because AI, for example, I think that there's a lot of things we can't even imagine at this point in time. We just try to test and try to have new innovations. But then where the conservatism comes into the picture is, of course, when we actual do the actual implementation and take these called production as a supervisory tool and risk management tool. So the first step is to be very innovative and then to be more conservative when actually taking these on board. But from a supervisory perspective, I think more and more of supervision is based on data. And like EIOPA has repeatedly highlighted that this is one of the major challenges, that we don't have enough data. The data may be not consistent or comparative or forward-looking enough. So I think digitalization AI can help us in that respect greatly in the future. And I was quite excited with the used by EIOPA paper with what can be done in that front to see how these major risks and natural catastrophes impact. So I think this is very, very interesting. And even if you think about how natural catastrophes are modeled in the internal models for concern Solvency II as a regulatory requirement, I think these advanced data analytical solutions, satellite data, geotactical information, machine learning, things like that can help us a lot. As supervisors, when we assess these internal models and compare the different model approaches across firms, or when we ensure that these models are compliant with the regulation, which can be very rich in some points, and while we try to preserve the principle of accountability and model understanding, we must remember that ultimately the responsibility rests with humans. So what else I'd like to highlight here is the supervisory cooperation that together we can address this issue. Yeah. So my perspective is very positive, and let's be innovative at this point in time.
Very well. Thank you, Thea. Let me move now to Laurent. So Laurent, you founded a company which helps boost climate adaptation and risk reduction. Tell us a bit how the tech works.
I was muted too. Okay, thank you, Valerie. Yes, so I'm the co-founder of a startup that is an insurtech a company called Mitigate that is specialized in the prevention of extreme climate risk and especially flooding. So I think if we just set a little bit the scene and think about this from a very practical point of view, insurance today tends to price risk of flood in the best case scenario, postcode level or with a pricing grid. That basically means that if you were to compare house insurance to car insurance, you would basically be pricing everybody in with cars regardless of the way they drive or their claim history. So of course, claim history is being taken into account for flood risk, but what Mitigate looks at is not to only look at the risk at the postcode level, but to look at the risk at an individual property level in order to also foster and incitate, provide incentives to policyholders to take preventive measures. So our models enable insurers to understand if, for instance, a factory or a residential home have taken preventive measures such as flood doors or increase the height of the factory floor, what would be the implication on the projected losses. Of course, this is quite new, and this is something that insurers are now taking into consideration. So technology here plays a very important role because going from the postcode or going from a pricing grid down to the property, down to each asset, represents a very large data challenge because we need to go from tens of meters of resolution down to a meter resolution. And in this case, Mitigate doesn't necessarily, what I want to also make a clear message here about is that so Mitigate is not a flood modeling company, so we actually can use any flood model. And here is very important because resolution and data is always the competitive edge of the insurance company. It represents the claim history, their view of the risk, and so that's not something that Mitigate tries to replace. And here, technology is very important because with the way we can consume data faster and better using cloud computing today and fast APIs and monorepositories, it's actually possible to build a solution that plugs on top of the view of the current hazard and risk and exposure of the insurer without necessarily imposing a new hazard view of the risk. And so all of this, of course, evolves very fast. And with the Mitigate is 5 years old. We're registered originally in Norway. We then participated to the Lloyd's Lab Accelerator in London. Now we are operating in France, Germany, Norway, UK, and we're starting in Denmark and Switzerland as well. And of course, technology has evolved very, very fast during that 5-year period. We will have the opportunity in this panel, I'm sure, to discuss more of how AI and technology of the like can enable that scalability and transition.
Thank you. And indeed, we will revisit this theme of enabling prevention, risk mitigation, because there is, of course, a constant dynamic of, paying damages in case of losses, but there's also a very effective use of funding in mitigation and adaptation to break that dynamic effectively. So thank you, Laurent. Paul, if I can turn to you now. I see that your fellow panelists are quite enthusiastic about the topic of technology and how that can be an enabler with the climate change mitigation and adaptation. Now, do you feel the same? Because I mentioned earlier that there are also some risks, and one of the risks that comes naturally for consumers is greenwashing. So is that something that you are very sensitive about? Tell us about your experience. What are the red flags? How can consumers be deceived?
Thanks a lot, and thanks for having me here today. I think the first comment to make is that we don't really see AI or digital innovation as necessarily inherently positive or negative. AI in particular, if we take it as a tool, it's something which depends entirely on the incentives, the governance, and the rules that are around it. If AI, like other technology, is used properly, supervised and regulated well, then it can improve efficiency, reduce costs, it can process sustainability data faster, it could help investors to navigate complexity. So it can have benefits, but it can also amplify problems that are already there if it's not adequately regulated or supervised. So I think that's the area where we see a risk. If nobody can explain, for example, why an AI system recommends a particular product, prices a risk a certain way, or labels something green, sustainable, then we have an issue. So this can be addressed, though, by having adequate data governance, risk assessment with human oversight of these tools in place. On greenwashing, I mean, it's a term that implies deliberately misleading a consumer, I think, but we're facing a bigger problem than that actually here. We're looking at an issue where we don't really yet have clear definitions of what is sustainable. And if that's not the case, then it's really difficult to bring clarity for consumers. To get that clarity, we need sufficient data and we need transparency. Consumers are still struggling to compare products here, and I think they find the framework confusing at times. And if that's the case, we risk that demand won't increase. What we've seen on sustainability preferences, for example, what we've heard and had reported is that around 70% of clients have sustainability preferences, but they don't express detailed preferences. And this highlights the importance of having really simple, credible product categories. And if we have that level of information, rules, transparency in place, we're sure about the governance, the oversight and the supervision, then I think technology can play an important role.
Indeed. So what I'm hearing is a warning not to get seduced by technology per se, and Thea was mentioning data earlier, and that is certainly one of the avenues which is enabler for the use of technology. But what I'm hearing is that for consumers that's a bit far off. They are struggling to deal with the concept of sustainable finance, sustainable products. So we shouldn't err on the side of complexity, refinement, granularity technology, because for a consumer, this is largely not what they are potentially interested in, or not what they want to hear before they make an investment decision. So I think that's a really important angle. And I heard you calling for definition, simple categories. So that is probably a very important angle, and we'll come back to that later. But now I wanted to turn to Fiammetta and EIOPA. So can you tell us a bit more about what EIOPA or EIOPA, I'm not quite sure how to pronounce it, what are your activities in this area? So I understand that this is about Earth observation data, but I'd like you to tell us how that can contribute to the green transition, and whether you do see, same question, whether you do see digital innovation in insurance and pensions as net positive in order to advance sustainability objectives.
Yes, thanks, Valerie, and thanks for having me here. So my name is Fiammetta Diani, and I'm from EIOPA, the EU Agency for the Space Program. So let me answer the first question that probably is in the head of the people behind the screen. So why a space agency coming to this panel, and what they do have to tell us? First of all, EUSPA is an agency of the European Union. European Union is the first investor today in space in Europe, and we do have services up there that my agency operate and make available for the citizens to navigate, to observe the Earth, and also to communicate. And this is becoming more and more known, but still maybe it's not so known in the wider public. So why here? We heard that the technology can be an enabler, but can also confuse the consumer. Actually, our satellites give a big picture and give it based on data that cannot or is difficult to manipulate. So that's already a first starting point. But let me go a bit more in detail. So if I go back of 10 years and I say space, everybody thinks of astronauts, exploration. I think today we are much more clear that space can make a change in how we do our green transition and we build our economy. At the agency, we published a couple of years ago an analysis of how EU space, the space of the European Union, can support the green transition in manufacturing industry, in energy, and in services industry. We will also point to it in the chat so that you can have a look. So really making a difference in many sectors. And what about insurance and finance? So we noted from our analysis that Earth observation, so the satellites used to observe our climate, our atmosphere, our land, are one of the fast-growing market for space. And around of 20% of the annual growth expected in the space services. And so we started to dig a bit more inside and to understand. But let me start maybe with a story because, I can say things, but we recently engaged with an insurance company based in Poland in a project. They decided to, let's say, innovate with us. And we asked them why. I mean, you're not very close to the space segment. And they say that they experienced the storm Boris. I don't know if you remember it, but I do, because I was in Prague waiting for the floods to come at that time. Our headquarters is in Prague. And it's this big, let's say, floods that has eaten Central and Eastern Europe in September 24. And they told us that Poland was one of the most affected countries, 18,000 properties, 2 billion damages, and their trauma or their shock was that how they were lacking information on the vulnerability of their insured portfolio for this specific risk. And also they didn't have any real-time information as the event was coming. So we started to work with insurance around Europe, and for example, MAPFRE, AXA Climate, Victoria Assicurazione, and many others, to demonstrate how satellite data can improve flood impact understanding and also the wildfire risk modeling. So we started from there and we developed. And we do believe that this Earth observation satellite data can give important insights on the estimation of losses after an extreme climate event, faster, more accurate claims assessment that can be done, as well as it can enable the risk model estimation, so the likelihood and the impact of the climate events. So a more granular risk segmentation, a more accurate premium setting. So these are just a flavor of what can be done with the satellite images. But let me conclude with the question about the net positive. So where is the net positive? So Copernicus data, that is our main system providing Earth observation images in Europe, is a public service and deliver data for free that are freely available. However, to make it meaningful information, for example, in the insurance or green finance, we need to elaborate this data. So it does not come completely without a cost. There is a cost, also a cost of changing the way we use this data. But we do believe that the advantages that we have both in prevention but also in acting after are much higher than this cost. are not even comparable. And this is why we engaged with the sector to demonstrate it, and I will elaborate maybe a bit after also what we're doing with the EIOPA. So I close it here, and thanks for this opportunity once again.
Thank you, Fiammetta. Really exciting how we can see the concrete implementation of cutting-edge technology with well, the bread and butter of insurance, which is, you know, risk modeling and processing claims. So I can't wait to hear more about that. Perhaps for the second round, more on the supervisory side, as you've given us a really good example of partnership with insurance. Now, what I'd like to do now, if that's okay, is go back to our Slido and see if we can maybe put it on screen to look at the responses. Now, this is interesting. This is extremely interesting. I must admit, I expected more of a data, AI, or tech angle, but no, it seems to be nature-based that really corners the votes. Can I ask whether one of the panelists wants to come in to comment, or are you surprised as me? Paul or Laurent, anyone?
Yeah, happy to. I'm really pleased to see, in a way, that nature-based solutions are there. I think they're key to resilience. I think one thing we know is that intact ecosystems can serve against buffers, against the impact of frequent and extreme weather events. So I think they're really key when we talk about resilience. And insurance can also play a role in this area, helping to ensure and invest to restore nature, protect nature, and recognize the role it has to reduce risk. So I think that's a really good result that's recognized in the Slido.
Indeed, and it is quite surprising to the extent that the technology evangelists dominate the public discourse, but clearly that is not a one-sided view. Laurent, did you want to come in, or shall we move on?
Yeah, we can. I can add my points here. I think also what's interesting is, I mean, data, AI, tech-driven resilience. I mean, maybe it would only be fair to add them up to maybe compare to nature-based solution itself, because I think we can't really completely dissociate the data AI aspect, which is basically the angle of how do we source the right data at the right level with the right quality, and then tech-driven resilience is basically how do we plan, how do we understand that this data enables us to make the right decisions. Of course, nature-based solution is a huge part of the solution, because in lots of areas we worked in the Ahr Valley in Germany after the on a case study there on factories that were in the area of Stolberg. It's a very small area that was hit very badly by the burnt floods in Germany in 2021. And we could prove that using nature-based solutions like regreening or detention ponds up into the catchment would have had a return on investment of, I don't have the number right now on the tip of my tongue, but it was more than 10 compared to the damage that was led to that very city, and we excluded everything outside of the area of interest. So absolutely agree. But the data and the tech-driven resilience can actually help us to get to the conclusion that the nature-based solutions are the right solutions to apply. So I think let's not oppose things, and let's look at it as where nature-based solutions is the right answer. And unfortunately, it's also not the solution everywhere. So I think it's a great and nuanced answer that I think sort of shows these different views.
Indeed. And one more reaction, maybe, Thea, before we move on.
Yes, thank you. I'm with you, Valerie. Quite surprising result, but this is something for us to think in the future, of course, first of all, in the markets, but for us also that, from my understanding, this is very good perspective. So quite surprising, but good, yeah.
Excellent. So let's move on, if you'll allow me. Now we'll move on to the second round of questions, and they're a bit more individual. So, Fiammetta, I wanted to start again with you because you gave us a really good example of a cooperation between EIOPA and the commercial sector with the insurance sector, but you also mentioned working with supervisors, and I know that EIOPA and EIOPA have recently collaborated on a proof of concept involving Earth observation data. So can you tell us a bit more about this?
Yes, indeed. And let me also thank Steya for quoting our white paper and cooperation in the beginning. Indeed, EIOPA and EIOPA has just released a joint white paper based on the experience we did together. We will also put in the chat the link to it so you can have a better look to the content of this white paper. So the objective of our work together is to accompany the sector into better understanding and exploring how this Earth observation, and especially our Copernicus, our system that is free, open, and reliable, offer a baseline. And we are pleased of this cooperation because we already see the success. So there was a certain echo. It was pretty well known around. So we see already the first effect. And what we do there, so we analyze what are the possibilities, the concrete possibilities to use Copernicus. So as we said also before, that observation and Copernicus permit a faster and cleaner view of what happens, of the disaster. And in the publication, we saw example where floods have actually, we can understand, have actually hit. Also when the ground data are limited, or we have a better understanding of the economic losses. So with the satellite imagery, we can translate the impact of the natural disaster into a more reliable estimate of the damages. But let's go to the supervisors, because this was our main target. We have a bigger picture. So Copernicus provides also a consistent picture that is across the countries and across the different type of events. For example, we have an enhanced data access, so we reduce the reliance on the self-reported or incomplete information that the supervisor may receive from the insurance. And this permits more informed and faster decisions in the end. But also we have a more comprehensive spatial coverage, what we call spatial coverage. So what is it? Global and consistent monitoring, for example, across the regions, the different regions, including the remote ones and the high-risk areas. There is also the possibility to have cross-border risk assessment or also comparison, or to improve the oversight of when an insurance portfolio is dispersed geographically, so to have a bit of the bigger pictures. It also enables the transparency through independent and auditable data. Let's remember that the data that come from the satellites, and in particular Copernicus, that is a public service, public funded system, are actual data that are pictures. So they are traceable and reproducible data sets. So it's not the other technologies that we mentioned, but it's a real picture, so real data that come from the top. And also there is a supervisory value. For example, they improve the risk validation, or enhance the early warning and the post-assessment capabilities, and support overall the evidence-based supervision and also the policy making based on these evidences and supervision. So we do believe that also, apart from the private sector and for the insurers, there is a real value also for the supervisory as well as for the policy making enabled by this system. So I think that This is a very important topic, and if you would like also to explore more, we'll go back to it. We will have soon in Brussels an in-person and hybrid event on 1st of June, to which I would like also to invite our audience, and I will maybe in the end give a bit more insights of how to join it.
Thank you very much, and very nice product plug. Excellent. I'm really liking the simplification and the burden reduction angle here of relying less on reporting and essentially using data straight from the source, and evidence-based supervision. What's not to like? And I want to remain on this this topic really, and I'm going to turn to Teja. I mean, who better to ask about evidence-based supervision? So Teja, and of course you benefit from your dual perspective of being part of the EIOPA management board and of the Finnish Financial Supervisory Authority. So how do you see digital technology, and in particular AI, helping supervisory convergence on new topics such as sustainability?
Yes, thank you. And well, first I have to say that when I say EIOPA, I mean EIOPA as an authority, but many times I also mean EIOPA as a community. So EIOPA are all national supervisors, so we together can make a difference in this. And using AI and digitalization in general is an area where EIOPA can add the great value in enhancing the quality and effectiveness and efficiency of supervision, and therefore also supervisory convergence. I come from a very small supervisor, but we are lucky enough to have some individuals who have very deep knowledge in climate change issues, with actuaries. But as a supervisory authority, we do not have the resources to develop innovative supervisory tools. So therefore, for us, EIOPA, and working with our colleagues in different national supervisors, I think is vital. Climate change and all other ESG risks will eventually hit us all, our markets and citizens. So in order to be prepared, we have to work together at EIOPA and the EU level. So EIOPA's role would be to create common reference points, methodologies, tools, and expectations to allow national supervising to assess risks more consistently. And EIOPA and the Center of Expertise for National Catastrophes helps us all to keep up with this, with the fast development. And to working together also with other other authorities like EIOPA, ESMA, for example, or these have just recently approved joint guidelines on stress testing the ESG risks. And I think these innovative, these tools are very good for our convergence in supervision in insurance, but maybe why not also in all financial sector. But yeah, the people supervisors value in using AI to add transparency and independent benchmark to leveraging open data, such as digital observation data. And not AI to be a black box, but maybe even open the black boxes sometimes when we compare, for example, different models and outcomes of those models. So I advocate of cooperation between supervisors and EIOPA and all my finance sector.
Indeed. So AI is a great enabler supporting greater use of data, again, evidence-based supervision, I heard center of expertise, all around the same theme, really. Better data, use it more holistically, and use it better, use it faster. Now, Paul, if I turn to you from the consumer side, I wondered if you could tell us a bit more about this report that you co-authored on breaking the spiral of uninsurable climate losses, where you welcome EIOPA's views on how to manage sharply increasing losses, so the liability side, up to an EU backstop. But you also go beyond this and you suggest an asset side pillar. So can you tell us a bit more about this?
Yes, happy to. And I think one of the main ideas we have and we want to bring forward with that paper is the idea that resilience needs to be long-term resilience. And we need to obviously work on prevention and adaptation, key points to raise, key points to work on. But we also need to make sure we don't get into fall into the trap of putting all of our focus, all of our investment and all of our efforts into preventing risks that we face today, but not take sufficient action now to prevent these risks growing exponentially, and to a point where prevention in the short term can become increasingly expensive up until the point that it's unaffordable. This is the idea to add an asset side pillar, to have that focus, is to ensure that we do also continue to have at the top of our minds that we need to invest in mitigation and reduce these risks, stop them from growing to a point where prevention might no longer be possible. So I think that's one of the key points we wanted to bring in the report. We try to look a little bit at how different activities can be financed through this pillar, and what's potentially already an activity that can be financed, what's profitable as it is, what could be profitable at scale in the future, but also at what doesn't really yield a significant financial return, and where we're talking less about perhaps investment and what might qualify as having a need for spending and public finance straight off, even though it might have a potential longer-term positive impact on the economy. Although, as Laurent mentioned, there are areas where nature-based solutions and others can fit those gaps as well. So I think that's a critical point to come on and to look at. We do fully support the EIOPA proposal as well, and we do see the need to move forward with that. But we do feel that this view is just essential, not to get trapped into that short-term only resilience now, prevention now, but just to remember that we need to also keep bringing back and locking in that longer-term perspective and that mitigation.
Indeed, and I think it's one of the difficulties of this theme that humans have a short-term bias, and also a disadvantage that complete climate chaos is not something that we've really experienced. So that makes taking the longer view more difficult, and I know that in the report you consider a number of, so on the asset side, again on the investment side, you consider a number of potential areas and instruments, and I'm trying to get a feel for how to bring this about, where some might be very long term, the return on investment might be very difficult to assess or calculate. So how do you think this can be incentivized if some of these investments are not really bankable?
Yeah, thanks. So I think it is about trying to separate out those distinctions, trying to look at where we can and use public finance in a smart way here, in a clever way. So try to use it to help target those areas, and some projects and some areas may never be bankable. You know, they may never be a project that we can finance through private markets, and it may just need public investment. So we need to be aware of that. But that public investment will also potentially have a longer term positive impact on the economy. So I think it's important to recognize that as well. So I think the key is to break down the activities to where they are, where they can be profitable, where they are already profitable, and to use public finance in a smart way to help perhaps bridge some of those gaps where needed, but also crucially, we will need some public spending in areas where perhaps projects will never be bankable, but where there will be a long-term positive benefit.
Thank you, Paul. Now, Laurent, if I turn to you, so is it fair if I call you a tech enthusiast? Would you accept this
I would,
catchphrase?
absolutely.
Okay, so here's an open question for you. So whatever tech comes our way, whatever the developments are, how far do you think can adaptation take us in reducing physical risk losses?
Yeah, that's a very good question, and I want to also make sure that I'm happy to be labeled the tech enthusiast. I think it's important to have diversity in this panel and sort of all have different hats. But I want to make sure that when you open your news today and you think about tech and you see about the big American development and so on. I don't want to be labeled as marketing, and I want to really make sure that this tech is really based on data and evidence. So I would just share two examples because that's data we currently have and hold, and those numbers are I think very much in the direction of what Paul just discussed with regards to prioritizing investments where it makes sense. And basically, we screened with our data the entire territory for the UK and for Norway. We're about to do this now in France, Germany. And what we find out in Norway and UK is that for pretty much any territory, municipality, or any way you can break down with regards to administrative board areas, basically focusing on 5 to 15% properties with the highest return on investment would lead to a reduction in losses by 50%. So there is not that much more to say actually to that fact. Is that yes, I agree that data brings a new light and can potentially also identify that some properties are more at risk than others. There are different approaches where socially we need to respect the role that insurance has in the first place, which is that it's a mutualization of risk. The goal is that some people are at high risk, some people are at low risk. And that's the role of insurance in the end, is to make sure that everybody in the end gets some type of cover. But down the line, what will maintain insurability in the long run is to remove the bulk of the losses that are highly repeatable and that are generating this threat to the model like we currently have. So when we reverse engineer that and we can see, okay, by actually focusing on 5 to 15% of properties, depending on where we are, we can reduce losses that are achievable to be avoided by 50%. Now, there is, of course, a reality, which is that depending on where you are, depending on the building stock, depending on the type of hazard, how it's been built, the ceiling of how much can be avoided will change greatly. So if you're in the UK in very flat areas, or if you are in Norway between two mountains in a very narrow valley, the level of hazard is so different that the avoidable losses can vary from 20% of total losses to 80%, because if you're just dealing with stagnating water, it's actually really possible with shallow amounts to reduce those losses massively. But if you're dealing with a rush of water, or a gush of water in a very narrow valley, you can do pretty much anything you want, but those properties will get flooded, and any preventive measures will have limited effect, unless, like we said, we do things like nitrate solution in upper catchment, etc. So I would say, yes, it's about. Of course, it's complex. It requires a prioritization of investments. But I think it's important to remember. I think these 5 to 15% properties leading to 50% loss reduction, and that's, I think, where we should start by looking at where to apply prevention. So I'm very optimistic, and I think the data will enable us to do the right choices. And I'm also a very big supporter of the initiative launched and proposed by EIOPA, which is called Protect, that was submitted recently. I think this is exactly where we need to go.
Thank you, Laurent. And indeed, I was thinking about that, because I guess there are two sides to this question, and let's actually focus on the questions now. We've got a couple in the chat, and I really invite participants to send more. And there is this tension between the more granular data, better location data, with its dimension of awareness. So in other words, that's allowing citizens, consumers to get real and clear about the risks they may be facing, with a view to start looking at prevention or risk mitigation measures. But there is also potential downside to this, and that's the question that was already in the chat for a few minutes. So will more exact location data lead to more or less social exclusion as regards the possibility for vulnerable consumers to get decent insurance coverage? So that's the downside of having more clarity on the perils. That's the risk of unaffordability, or indeed being completely excluded from coverage, as we see already happening, beyond the borders of Europe. So who wants to come in on this? Paul, from the consumer side, please go ahead.
Yeah, happy to. Thanks, and I think it's an excellent question. It's an extremely important point, because we have a lot of potential that Laurent's mentioned, that we've discussed already, about how and different things, not just the elements that we've touched on already, but also how more data from connected devices, Internet of Things integration, could help make individual clients more insurable. By getting a better idea of their risk profile, more detailed data and idea of their risk profile. But I think the key there is, does it become an inclusion or exclusion element? And the key point there is, how far do we put it ahead of prioritizing mutualization, or behind that? Does the principle of mutualization remain the first key principle? And do we use this to include people who might otherwise be considered extremely risky? Or does it rather become an excluding principle? So I think that's key, and I think linked to this as well. I mean, and the use of more technology in general, but more processing, more elements, more complexity in contracts where you might be linked to devices. That's something to consider as well, and it's back to a point that Taya mentioned earlier, and that we've discussed, is that if we bring more complexity into products and into the offerings, we're probably going to need more complexity in regulation and supervision and oversight. This is a dynamic which we've seen up until now. We've had a lot of complexity of regulation potentially created, but it's complexity that follows the financial system and products and markets as it tries to ensure a good level of consumer protection. So we may need to also add additional complexity to ensure same levels of consumer protection where we bring in this new innovation. So I think it's a point worth mentioning as well.
Thank you, Paul. And indeed, because we're focusing on climate change and climate risks, you mentioned wearables and the input that technology can send to insurers about certain risk factors. And if you ask my smartwatch, did I go to the gym this week? That's that dimension, which is now becoming increasingly common. Now, I see another question more for Laurent. So Laurent, really about the risk assessment and how you take into account adaptation measures. So the question is, how do you know the net climate risk of a home at house level? So in other words, how do you know the risks, and how do you factor in adaptation or mitigation measures that have already been taken? Is that something that your technology can achieve?
Yes. So in terms of the net climate risk, so it's a matter of, so of course the risk formula is hazard, exposure, vulnerability. The hazard comes in from any flood model. If we take the flood risk aspect, the exposure is a value at risk and what could be lost if water were to enter the property, and the vulnerability is basically how the shell would resist and how the shell of this property would actually let water in. So what we do is basically to really have a as close to the truth understanding of each property, which is to first of all estimate the hazard level, then of course factor in the exposure, and then finally, which is where mitigate focuses most, is to basically build a very detailed vulnerability model based on the building property type, the age of construction, the type of material, and etc. We now have support. We work with specialists from UCL, Delft, and also SINTEF in Norway to help us do that, which is basically to understand, okay, this is the type of building I'm looking at. These are the ways of entry that water have in these types of buildings based on that location and context and hazard level set around it. So that's how we approach it. So to understand, and of course, when we say climate risk, it needs to take into account climate projections. So we also, every time we can, we want to work with hazard models that are future looking, that do not only look at past events. And from the adaptation of prop and the the existence of existing property adaptation measures, here we take the angle pretty from a very straightforward view, which is that if the information is already held by the insurer, they can actually connect to our APIs and indicate what measures have already been taken. Very few insurers have that data unless it's for large industrial sites and they've already surveyed them. So we are able to then take into account, let's say, the IKEA store has a large issue with runoff water, and they already have a detention pond or tank under their car park. Then we can factor that in. And recalculate the new risk level based on that capacity, the capacity of the detention tank, for instance. So this is all wired in so that when the policyholders are reporting information, this can be brought in. We also have a collaboration with a company that enables us to take pictures that are certified in terms of the measures that have already been taken. So if the policyholder reports have already implemented the flood doors, they can then take pictures and then record that, and it goes directly into the core system to take this into account, thanks to the use of AI to identify that the measure is valid and was implemented in the right way. I just want to also add to the last point very briefly, and I think there there is someone who has been writing a lot about the last point on the discrimination of the risks, which is Thierry Langrenet in France, who has submitted also a lot of appeals to some of the papers that the Commission were putting together. And in France, there is something that is currently being tested that is it's called Observatoire de l'assurabilité, which is basically an observatory that looks at insurers that are starting to retrieve from very high loss concentration areas. And the French government, of course, it's part of the climate and adaptation policies, want to basically flag openly insurers that do not play the role of the mutualization of risk. And of course, currently the law doesn't say what will happen, but this is something that I think maybe as an observation can also be added to the mix.
Very interesting.
Valerie,
yeah.
Valerie, can I add
Samantha, please go.
at this point? Yeah, because I was thinking, to the different questions that we received and what we can do with the satellite data. So, for example, till now we have based. I was traveling in the US a few years ago, and I ended up in a very nice valley in California, and it was abandoned. Houses abandoned, everything abandoned. And when I asked the ranger why this was, and it was because they were not possible to be insured anymore because of a couple of past events that were pretty destroying, and so no insurance committed. So, and this is a bit the fact that we are basing on the past our calculation of the risk, or they were basing. So now the technology evolved, and with satellite data and also with the Copernicus, we can do projection, for example, of temperature, of precipitation, so we can base it on the future, because also the climate adaptation is ongoing. If I look at my city, Prague, before it was subject to floods, now these floods are controlled, and it didn't arrive in the end in 2024. So we need to also evolve our way of assessing the risk. And in our projects, very interesting, one of the companies that engaged with us has shown us a case in which there was a parcel of a forest that was considered not insurable. And in the end, with a better model they set up using the satellite data, they ended up to make it insurable. So it's also possible to distinguish in a better and more accurate way. So there is the risk, and it's pretty recognized that it can be misused, but there is also the opportunity, and we saw it coming, that permit also to increase the insurability of certain areas subject to climate risks. So just wanted to add this, and the satellite images permit us the future forecast as well, and not only to check the past.
Indeed, and I think that's really, really important, as what we are observing is an acceleration of the change and therefore the impacts. And that really begs the question of, is historical data still reliable? In certain domains of insurance, there might be, but for the covering of damage linked to climate events, that is a question mark. Are future projections more reliable than past data, as the technology helps make these predictions more accurate and based on more refined models? Now, I'm just looking at whether we have more questions in the chat. We have one more, and I really like it because we're talking about pensions. We've not really been talking about pension funds so far. So let's have a question on pensions, and that's possibly a question for you, Paul, again. And the question is, how can pension funds support the climate transition through their investments, of course, while avoiding greenwashing and protecting the interest of pension savers? And can I sprinkle a little technology question on top of this? What say you, Paul?
Yeah, absolutely. So I mean, I think obviously there's a nice matchup between the long-term investment profiles of pension savers and some of the investment that we need for climate resilience, so that we've already mentioned, right? So having a long-term investment profile works well. What's also very, very clear for pension savers is that they want their money and their pensions still to be there by the time they get to retirement age, which some time off. And we talked about what we can see and what we can infer from historical data. In models that can improve, but we also need to be cautious because at the moment, some of those underlying models, we call what might really be the most likely scenario an extreme scenario at times. So we do need to be careful a little bit as well about what we're looking for, what we're modeling, and anyway how far we're basing on past data, because we know that these events as they are at the moment, and climate change and risks emerging as they are at the moment, are non-linear events, and also will change dramatically as we hit certain levels past certain tipping points. So we need to be cautious. So that's a very key question for pension savers is what do we need to do now to insulate ourselves and their savings, ensure they're there in the future. And I think that there are measures that they can do. But I think one key point is that if that money is invested, at least in part, sustainably, and sustainable investments are prioritized, they could be good matchups, and they will also have a risk-reducing element to them. So they will be, by investing in the transition, reducing the risk of increasing climate change as well. So that's also the logic of the paper that we've written on the protection gap, and also one of the reasons why we want to try and introduce the idea of conditionality for access to public finance in the paper, where we ideally want insurers, pension funds, and others to be actively investing sustainably and helping to reduce that risk overall for the system.
Indeed, there are insurers taking the long view, and then there are pension funds, which, one up. Now, we're getting towards the end of our session, and really thank you for the rich content so far. But I was wondering whether I could ask you to each come with a sort of a one sentence or one topic conclusion. What would be your contribution to creating this environment that supports business to change in order to move towards this green transition, this greener future, with the support of technology? Who wants to start? Shall I volunteer to you?
Yeah, thanks. What first came to my mind when listening to this interesting discussion is that I think the key idea is cooperation. You need cooperation of all stakeholders, be it insurance undertakings or pension funds, different supervisors, consumer side, or even I was just happened to talk this morning at the bus when I was coming to work with one accountant of mine who's working on land use planning, how to plan the built environment, cities and municipalities. So even for those people, we should be doing cooperation that what kind of cities and housing areas we are building to have sustainable environment. So my takeaway would be cooperation from this point. Thank you.
Very well, thank you, Thea. Laurent.
Yes, I think it's I would say if there is one thing that I would like to add is insurance is a very complex and slow changing industry, but we've already seen like you said, some insurers, some pension funds are already taking that route of making things change. Mitigate was founded in Norway, and we have a pretty impressive example of Gjensidige, which is the leader in the market in Norway, one of the largest mutuals in the Nordics. that are already, talking on a daily basis to their policyholders about prevention, about what type of measures they should take, about why it makes sense. And so I think it is important to, as a European, you could think about Europe in some ways as us all speaking different languages and having different regulations as being sometimes a slight, I would say, disadvantage compared to the US, where you can just, as a company, just enter a market and get very quickly everywhere. But I think what's the strength of the European model here is that we have very, very many different insurance models and very many different insurance companies thinking in different ways. And the solution actually is already in operation somewhere. Using satellite data, using the right financing tools, using the right public disclosure system. So it's about, I think, and then I'm just throwing the ball to you guys on the regulatory side, but which is about really finding the best students in the class and just use them as example for the rest of the continent to follow their lead.
Challenge accepted. Paul, over to you.
Thank you. And I think as a final thought, I mean, just I would go back to what I mentioned already. So I think we've got a lot of excellent things and interesting ideas that we've discussed here already. I think just keeping in mind that long-term resilience, and also making sure we know and we check what the value to the consumer is of using different technology, different innovation in this area, making sure that there is a discernible benefit, that we have the principle of mutualization high in our minds as well, and that we use it for the good that it can do. I think that's absolutely key. It's something that we'll support as Finance Watch and as in the work that we do moving forward, but also I think crucially going back to that point that we mentioned right at the start on the need for sufficient data and also information transparency on products. If we want to give consumers good information, if we want to make sure that they're well informed, we need to make sure that data is there, that the transparency is there, that companies have it and can pass it on to the consumers, and something that perhaps we've seen concerning developments on recently as well. So we do need to make sure that's still a priority.
Thank you, Paul. And last but certainly not least, Fiammetta.
Yes, thanks. So 2 messages from my side to wrap up. The first one is that we really believe that this space data and space technology can make it better, but we are also aware that it's not easy. It's not immediate for insurance supervisor, finance companies to use them. And for this reason, we are here to help. So you can either get in contact with Marie Schuller from EIOPA or directly with EIOPA. There is me and my colleague Leila Jabou. And we can provide 2 things mainly at EIOPA: advisory of how to do it, but also pilot. So if you want to try it in real, we can help piloting it. So it's easier then, and the risk is lower of adopting a new technology. So please get in contact. Second message that I anticipated, if you want to learn more, we are organizing in Brussels on 1st of June, a dedicated hybrid event discussing the usage of Copernicus for climate risks in reinsurance and finance. There you will hear also testimonial from banks, insurance company, how they onboarded this data, how they are doing it, and we have already opened the registration, so we will put the link to the registration in the chat. So if you want to learn more, that's a good starting point.
Thank you very much. So I heard a lot of things here. I heard cooperation from Thea, may I say also supervisory unity. I heard from Laurent the diversity and the dynamism of the fabric in Europe. That's one of our strengths. I heard Paul empowering consumers, giving them the information, reliable information to make the right decisions. And I heard from Fiammetta how the data from the Earth observation can make better risk management decisions, but also support the risk mitigation. And I really want to add a bit of optimism here, because I really believe that tech can be an enabler, can be an accelerator. And I believe in the power of innovation. I mean, after all, we did not come out of the Stone Age because we ran out of stone, right? So that was really transformation, innovation, human creativity. And I want to believe that we can really use this to our collective advantage in this discussion. So for me, it's about recognizing the benefits, enabling, empowering. But because we are supervisors, we also look at the risks. And we will do our very best to make sure that these risks are identified, maintained, contained, and we stand ready to work with the European authorities and decision-making bodies to support that. So on that optimistic note, I really would like to thank you profusely for your contribution. I think that was a really lively debate with great surprises and great questions from the audience. So thank you for your engagement. And on this note, I will hand back to you, Carlos, for the next session. Thank you.
Thank you so much. Thank you so much, Valerie, and of course to your panelists. Very warm thanks also from my side for indeed a very rich and very thorough discussion on a very wide range of topics. So with this, I think we come then to the last item on our agenda for today, which is we heard throughout the day on diverse occasions some references to these aspects about supply and demand. I mean, around this theme of the insurance natural catastrophe protection gaps. We keep, of course, seeing these different perspectives. We talked about supply. How can we strengthen the supply to promote long-term affordability and availability? But of course, there is also an angle on the demand. How can we promote demand from the consumer side? So, and this is really a good segue, these previous discussions, to the next presentation, which I'm very happy to invite my colleague Marco Traversa, who is team leader in our Conduct of Business Oversight team at EIOPA. And he will share with all of you very interesting work on several initiatives that we have been developing from EIOPA on precisely this demand aspect. What can we do to ensure consumers understand their coverage, what they are covered, but maybe also what they are not covered. So with this, I hand the floor to you, Marco.
Thanks a lot, Carlos, for this introduction. And indeed, as Carlos mentioned, I think this morning we started at the macro level. Then the previous panel looked at financial innovation, and I was very glad that Paul made a brief introduction to the topic. The purpose of this presentation is to look at how can we ensure that consumers understand what they're covered for. So when there is coverage available, when they require coverage, and when they buy coverage, how can we ensure that they understand what they're covered for, and also that they know where they can get coverage. I will try to answer this question. Of course, I'll be happy to answer any question as well from the audience at the end of my presentation. But maybe before going into my presentation and before sharing EIOPA's perspectives and EIOPA's work, we have a brief slide of Paul to see what the audience thinks about why are consumers not understanding, and in particular what we would like to know is which of the following makes natural catastrophe insurance policies difficult to understand: unclear technical language, differences in coverage and exclusions, all of the above, and specific limits and conditions. And maybe we'll take a couple of minutes before we have the answer. But in general, I think I can say that the answer is heading towards head of all of the above, which is a bit stealing a bit the scene from my presentation, because indeed what we see at the EIOPA is that there are a number of factors that contributes to consumers' limited understanding about coverage exclusions and about the availability of protection against natural catastrophes. I think the answer is clear, all of the above, followed by specific limits or condition hidden in the policy terms. So I think a very clear answer that there are many factors, but indeed for us this is a main issue, and this is what we've been trying to explore and address at the EIOPA together with our members for a number of years. With that, maybe we can move on to the presentation. What I would try to answer today is, why are consumers not buying natural catastrophe insurance even when available? I think this morning we look a bit how can we provide coverage, how can we provide more affordable coverage. However, we also have a problem. In many areas, natural catastrophe coverage is available, and yet consumers are not buying it. And then the second question we would like to try to answer today is, do consumers know what they're covered for? And how can we ensure that consumers understand what they're covered for? And of course, you can imagine that the answer to the second and third question is somewhat leading toward the full answer of the first question. And next slide, please. Maybe just setting the scene and a bit the context, and I won't go in detail. I think you've been hearing about natural catastrophe, about increasing natural catastrophe, but what we wanted to highlight is that natural catastrophe are intensifying in severity and frequency, and we see that across the continent, from north to south, from west to east, they are impacting consumers with different type of natural catastrophe event. And as you can see from the next slide, despite this increase in natural catastrophe, we observe that coverage is still limited, and many consumers are still not buying coverage. Next slide, please. In particular, what we observe, and I think this number was repeated by Petra, was mentioned by Marie, Valerie also probably alluded to it, what we see is that despite this increase in events, we still see that from 1980 to 2024, only around 1/4 of extreme events in Europe were insured. And not only that, our annual consumer research shows that the percentage of consumers who own protection against natural catastrophe remains rather low and unfortunately rather stable at about 20%. We've seen, for example, some peaks in some markets after some events. For example, after the earthquake in Croatia, we saw some increase there for consumer buying this. However, in general, it remains low, and not only it remains low, what we also observe is that those consumers who have protection against natural catastrophes, they are generally less satisfied with this type of product than those consumers that have other type of insurance product. And this is the last number in the slide. In particular, we see that only 61% of EU consumers indicated that they're satisfied with the claims handling process for their coverage for damage to property against nat cat events. And this compares quite poorly with other type of insurance product. We have private health insurance with 74% of consumer reporting being satisfied, and motor insurance with 70% of consumer reporting being satisfied. And next slide, please. So why we think this is an issue, and in particular we think is an issue, and Carlos already mentioned this, for both some demand side and supply side aspects. And on the demand side, what we observe is that consumers are generally not aware about the risk and the availability of product, but also they're not aware about prevention measures that they can put in place. And at the EIOPA, we have a number of projects. We have what we call Protect, which is a blueprint for the setup of a EU tool which would enable consumers to better understand the risk their property are exposed to and the availability of coverage. We also have been doing a number of fact sheets, financial education fact sheets, to raise awareness for consumers. And of course, we've done our extensive work on impact underwriting, which aims at identifies ways to promote prevention measure via underwriting. What we also observe is that there are a number of supply side factors, and I think I won't delve deeper into innovation because the previous panel looked at innovations, but generally we think that there is need for more innovation in this space. And for example, last year as part of our Digital Finance Week, we had a full day dedicated to innovation in this area. We also see that there is an issue of affordability, current affordability, as well as future possible risk of affordability, and also limited clarity in disclosure. And with this, we're doing a number of work, and I will particularly cover in the next slides what we've been doing in the area of disclosures. What we've done a study, two behavior studies looking at why are consumers not buying natural catastrophes. And we identify 8 main areas, and some are very broad, like lack of trust and low financial literacy, as well as other areas which are quite interconnected. In particular, one of the main barriers that we observe from the studies that we carried out is the fact that there is limited clarity of coverage and cost. And as a result, consumers perceive insurance being a luxury, or that they cannot afford it, even though they might be able to afford it. But also they perceive the process for buying natural catastrophe insurance as complex and quite taxing on their decision-making process. They also have limited trust because of past experience with exclusions that led to lack of coverage. And so basically what we did, we identified a number of interventions, and one of the key interventions is the need to simplify and improve clarity of disclosures. Next slide, please. Then this is what we did. We did basically dig deeper into lack of clarity of disclosures, and we identified that there are a number of risks that can lead consumers and conduct issues. Generally, what we see is that consumers might be underinsured because they have the insurance illusion, so they think they're covered for a risk, and then they're not. They also find it difficult to compare amongst products, and because they find it difficult to compare amongst products, they generally don't buy it, or they don't understand which insurance is more convenient, what can they afford or not. And there is also a risk of mis-selling. For example, some consumers might be wanting to buy flood coverage, and they might be buying flood coverage. However, there are a number of exclusions that limit flood coverage to pluvial flooding versus flooding coming from the sea, and so on. So if you're a consumer that requires flood coverage for pluvial flooding, then the key question is, if you end up buying other type of flooding coverage, then it's a clear case of mis-selling. So because of all these issues that we have been observing for a number of years, we did a detailed study last year. Next slide, please. Looking at insurance product information documents in a number of member states for home protection insurance. And we identified a number of issues. First of all, there were a number of issues vis-a-vis the fact that what was mentioned in the IPID sometimes was different than what was mentioned in the terms and conditions. But also we identified that there are a number of limitations both in the IPIDs and in the terms and conditions. Some are geographical limitations. For example, there are some specific exclusions that exclude coverage for flooding if a house is near a sea, near a river, even though maybe in the IPID is mentioned that flooding is covered. What we also observe is that there are some exclusions relating to flooding depending on the type of water or on the amount of water, and this is often specified in the terms and conditions rather than in the IPID. We also identify issues with the magnitude and limitation, in particular vis-a-vis earthquake, windstorms, that there are clear limitations vis-a-vis the magnitude and the Richter scale and the kilometer per hour of the windstorm. And we also found some times and frequency limitations. So you're covered in year X, but not covered for the next 5 years. The key issues that we identify here is that, ironically, some consumers buying, living next to each other, so being exposed to the same risk, but buying coverage from different type of providers serving that area, they might be in completely different situation, even though they might be technically covered for the same peril, but they might be in completely different situation because of all this limited exclusion as well as inconsistencies across exclusion and across products. So based on this, we started some work with our members. Next slide, please. And we basically have been working on how can we ensure that consumers understand what they're covered for, and we've been trying to work with members to promote clarity by proposing solutions to simplify disclosures and facilitate consumer understanding of exclusions. In particular, we are developing what we call a common list of coverage and exclusion for non-cat related perils. The idea is not to redefine the perils, but rather is to look at existing exclusions and develop a common list to simplify the customer journey for consumers as well as for provider, in the sense that provider can refer back to this common list, can use this common list, as well as consumer can rely on this common list to then determine, am I covered, am I not covered? This is, if it's mentioned that flooding is covered, this is what I can expect to be covered, and so on. This is still work in progress. We're still discussing with members, but the idea is that, of course, at later stage to also involve different stakeholders, because there is a need for industry and consumer buy-in, and also to have the inputs for industry and consumers. Next slide, please. Basically, I won't repeat, but generally the main objective is that we want to facilitate comparability amongst products. We want to simplify the process of developing disclosure for providers, as well as we also want to avoid mismatches between consumer reasonable expectation and what is actually covered. And with that, I reached the end of my presentation, and I saw that there are already some questions in the chat, and I'll be happy to take those questions from the chat.
Yes, indeed, Marco. So thank you so much for your presentation. I think very interesting, and it shows precisely what I was mentioning briefly, that all these dimensions are equally important. There is definitely also work to be done from the demand side in terms of awareness, clarity, and understanding of the policies. So there are indeed some questions already on the chat, and I would incentivize our participants to continue providing us questions. We will try to cover as much ground as we can. So the first question is, I think, interesting. So we are asked, how can supervisors ensure that sustainability-related disclosures by pension funds, so it's specifically on pension funds, but I think it's also, in a sense, something you can extend also to insurance. How can you ensure that sustainability-related disclosures are clear, fair, and understandable for members?
So I think this is a very interesting question indeed, Carlos, as you mentioned. I think this broadly applies to all institutional investors that have sustainable investments, and indeed, so the starting point was Europe was a head starter. When we started work on sustainability-related disclosure, we as European Union, we were at the forefront, in particular with the SFDR and the SFDR disclosure at the forefront. And of course, there were some issues with some of the disclosures not being simple and being difficult for consumers to understand. What we also did as a EIOPA, we did the mystery shopping on the sale of IBIPs, not really related to pension fund, but still long-term saving products. And we also identified issues with consumer having limited understanding of this. So there is now ongoing work to review that work, because we were at the head start, but we have some lessons learned, and there is ongoing work to review the work on the policy side. But also we have been doing work together with our members also on the supervisory side. And in particular, we identified sustainability and sustainability-related disclosures are one of the focus topics for our union-wide strategic supervisory priorities. And what we also been doing, we've been working with some members on developing a supervisory technology tool. So a tool that would look into different type of sustainability related disclosure and identify those at higher risk of being misleading or leading to possible greenwashing. The tool does not identify the ones that actually do greenwashing or that are misleading, but those that are at higher risk, so that then supervisor can be risk-based and rely on these findings to then further carry out further supervisory work.
Oh, thank you for that. Very interesting. And we kind of close the circle because we go back again to the technology and on sustainability as in other areas. Of course, technology can help us, as Valerie was concluding, to enable, to facilitate, and to also to handle huge amounts of information that otherwise we might not be able to tackle as supervisors. There is a second question that I find interesting because it brings a bit of a different perspective. It's coming from, I think, the Greek Association of Professional Insurance Agents, and it raises the question on whether, given this importance of expanding insurance coverage for natural catastrophes, what role should the intermediaries play? Is there also a need to upgrade the role that intermediaries play in this regard? So what can you share with us and our audience on that, Marco?
Indeed, Carlos, as you mentioned, very interesting question because it touched the last point of the insurance value chain, but probably a key point if we look at consumers. Generally, what we observe is that the majority of consumers still today in Europe, they do a lot of research online, but when they need to make complex decisions about purchasing insurance, they still prefer to have face-to-face and to rely on an intermediary. In the context of natural catastrophe, we think intermediaries play a key role in the sense that the intermediary's role is to assess the demands and needs of the consumers, what are their needs vis-a-vis coverage for natural catastrophes, and to advise them on a relevant policy. So to answer the question more briefly than what I was doing is, yes, there is a need to take into account the role of intermediaries, and intermediaries have key roles in providing advice, in assessing the demands and need, taking into account also natural catastrophe and consumer exposure to natural catastrophe. So, for example, if the consumer is looking to buy home coverage in a flood-prone area, and this is one of their needs that they have, an intermediary should not advise to buy just a basic, simple type of home coverage, but should present consumer with different options on how they can protect against that type of risk.
Sorry, I was muted while thanking you for your answer. And I was just mentioning that there is a kind of a follow-up question, which is also asking us within this interesting intersection between, let's say, consumer protection disclosures and uptake of NatCat insurance coverage. How closely, or is EIOPA working with brokers who are also trying to bridge between insurers and consumers? So is that also an angle that we are exploring? And there's a kind of a second point in this question, which is whether EIOPA is considering innovative solutions to that address these technical claims process challenges, with a specific reference to parametric insurance.
Thanks, Carlos, and indeed, very interesting question and very interesting to see the focus on the point of sales and on the role of broker. So are we working with brokers? Yes, I think brokers association at the European level are one of the key stakeholders that we have as EIOPA, and we're always in constant dialogue with them. I mentioned that we are developing this common coverage list, and the idea is to engage with stakeholders, and the idea would be to engage with insurers, to engage with consumers, but also to engage with brokers, because at the end of the day, if there was if insurers were to adopt voluntarily this common coverage list, then the broker would be the one that needs to explain it to the consumers. and looking at innovative solutions. I think we have not yet looked at the claims handling process. This is some of the ideas that came up last year in our day of the Digital Finance Week, looking at innovations. We are planning to do another similar event either this year and at the end of this year or early next year's. What we're also doing as a EIOPA, we are also testing whether AI can help the supervisor rather than the providers in identifying possible IP, possible disclosures that are not consumer friendly, so that carry a lot of the risk that we identified with our own manual analysis. So how can technology help us also in being more risk-based in the way we approach supervision?
No, very good. And because you were so efficient with your presentation, I think we may still have time for one more question, which is how do you balance affordability with the risk-based pricing to encourage mitigation? So maybe this is not so much directly a demand related question. Of course, we touched on this already a bit before when covering some other aspects, but is there any comment that you think you could add to this question?
Maybe I think first of all I would start with what we mean by affordability, and in particular our demand side work, our behavioral work found that affordability sometimes is not the real risk, but perceived affordability is the real risk. We did a study in 4 member states prone to natural catastrophes with low uptake of insurance, and one of the main reasons why consumers reported that they were not buying natural catastrophe insurance was because they couldn't afford it. Then we put them in a lab environment, in a behavioral scenarios, and we asked them how much you will be willing to pay to protect your coverage, to protect your home, and so on. And the average price quoted was higher than actually the average price on the market. So we think that affordability at the moment, there will be problem with affordability, and especially in some areas there are problem with affordability. And I think that was the panel this morning and the work done at the macro level this morning that will aim at tackling and identified ways to address this. However, there is also a perceived affordability because disclosure remain complex, and because consumers find it difficult to understand coverage, cost, and so on. What we observe is that affordability sometimes is perceived as, oh, I cannot afford, this is too expensive, when in reality, if it was better disclosed, if it were better presented, consumer might be able to afford it and might be able to buy the product.
Yes, indeed. And of course, I think it also comes together with the awareness point that you also touched upon, because of course, if the consumers are more aware of the risks that they actually face, and that we heard many times today, starting with Petra's intervention, that sometimes this the likelihood of occurrence of these events is also underestimated, then also there maybe the value of insurance could be better assessed against those losses. So thank you so much, Marco, for this very interesting perspective. A lot of initiatives and very interesting and practical work streams that we are developing, and you are, of course, very much active on this field, and we will continue, of course, to work on this going forward, because it is definitely one of the angles that contributes to the insurance protection gaps that we have today, and which are not really a situation we would like to keep. So thank you very much. And with this, I think we are approaching the end of our event. And I would like to introduce our last speaker of the day, and it's our Executive Director, Damian Jaworski, who just recently joined us at EIOPA, and I'm very happy that he's here with us today to share with you some concluding remarks about all that we heard today, all the perspectives, all the different topics that were covered. But I hand the floor to you, Damian, and again, welcome, and the floor is yours.
Thank you very much, Carlos. Good afternoon, everyone. I hope that you see me and hear me well. I'm delighted to dedicate one of my first public appearances to this important topic. It's a privilege to close this extremely well attended event because today's discussion captures exactly where EIOPA strategy is heading. Putting sustainable finance at the center, strengthening resilience, and delivering better outcomes for consumers. Let me take a moment to reflect on what we've heard today and where we go from here. We started this morning with a clear message from Petra. Europe stands at crossroads. We need to act now to close the protection gap and build resilience, or we risk facing the storms ahead unprepared with devastating costs for our economies and citizens. The choice is clear, and today's discussion have shown us the path forward. Let's take it. Hearing Commissioner Hekstra, it became even clearer that climate change isn't a distant threat. It's an economic and security reality reshaping Europe today. If I had to remember only one figure from today, it would be 25%. Historically, only 25% of climate-related economic losses are insured, and risks are set to worsen. So commissioners call for forward-looking risk assessments. Resilience by design challenges all of us to move from reaction to prevention, to make sure insurance and reinsurers doesn't just price climate and environmental risks, but contribute to reduce them. I can't wait to see the European resilience framework that should be adopted, hopefully in the second half of this year, and the EIOPA stands ready to contribute to its success. And then we dug deeper into catastrophe risk management. From the pool, 68% agreed yes, such measures can make system more resilient. The panel moderated by Bernard clearly highlighted, I think, one key aspect, how a European mechanism could contribute to creating risk reduction incentives starting from the top of the ladder. Rolf from ESM, as well as Patrick from EIOPA, made it clear how a European approach for pooling risks combined with a public backstop could contribute to economic resilience and financial stability, especially for risks that are too big to insure. This builds on the latter approach and should be combined with prevention, private insurance, financial markets, as well as existing public schemes. Marie from EIOPA also showed how important it is that we keep Solvency II smart and risk-based, because an insurer that incentivizes investments in resilience through well-designed underwriting should see the corresponding risk reduction reflected in its capital requirements. After break, we brought technology and sustainability together and discussed the impact of how other big digital transition and we had a great moderation from Valerie, who brought all different aspects and views together. Again, from the pool, surprisingly, a very positive surprise. 54% agreed that nature-based catastrophes can best boost resilience and support the green transition. We heard from a very good friend of mine, Teya, how AI can sharpen supervision, and her conclusions resound very well with me, that we need more cooperation, no doubt about it. Laurent, how data can help predict floods before they hit. Here, I would agree with him that diversity is what makes our strength in Europe. Fiammetta, how satellites can support risk assessment from space with data that is almost available in real time. She was really convincing on what Earth Observatory data can do, and we are grateful for the cooperation with them. This is something I can also mention from my national perspective. Paul reminded us why we do all this, and that none of this matters if consumers don't trust it, want it, and understand it. So keyword here is transparent data, and our focus should be on mitigation and adaptation. Speaking about consumers, Marco from EIOPA rounded up the day, bringing us back to the very basics. Consumers must understand what they're covered for. No jargon, no hidden conclusions, just clear, simple, and honest communication. Because a policy is only as good as the protection and value that it actually delivers. So where does that leave us? My personal take? The good news is the solutions exist, and we can have a positive impact if we act together. The protection gap, technology, and innovation can help shrink it. You have seen that it's already working in some part of the industry. Information overload for supervisors, automation can help us to focus on what really matters. Now the hard truths. Data can be messy. Without standardized high-quality sustainability metrics, it's like building on sand. Innovation isn't even. Some firms are racing ahead. Others are stuck in the starting blocks. Consumers, not all of them, are still skeptical, sometimes subject to various biases that prevent them to buy insurance. We have to go the extra mile to make sure they are adequately informed and get the coverage they deserve, one that has value for money. So our reality, we at EIOPA stay grounded on risks. We see the impacts that sustainability-related risks are having today, and it is increasing. Uninsured losses pose a burden to citizens, to businesses, to governments. They delay economic recovery and threat financial stability. Our focus is on developing practical, tangible solutions that add value and support long-term availability and affordability of insurance, strengthening society's resilience in a landscape of evolving risks. I feel very privileged to talk to such a big and diverse virtual room today, though I can't help to challenge you to stay out of your comfort zone. I mean, supervisors, raise the tools with appropriate safeguards, use tech to see further, act faster, protect better. Industry, stop piloting, start scaling. Prove that doing good is good business. Policymakers, clarify the rules and create an environment that backs adaptation investments, even the unbankable, unglamorous ones. Consumers demand better, ask for proof, reward the firms that walk the talk. A final word from me, actually two. Thank you to our speakers for the insights, to the fantastic EIOPA team for making this event possible, and to all of you for caring enough to be here. If you enjoyed the event, or if you feel you missed something today, please let us know using the feedback form. Your feedback really matters because improving things is a two-way street. With this, ladies and gentlemen, thank you very much for attending today's event. The conference is adjourned.